The Fed has been trying to talk this market down, and in the end, the equity market has simply ignored it.
Different sectors of the economy are performing in different ways.
The market's gotten more and more selective.
I think we can all agree that the economy is a lot less interest rate sensitive than we thought.
Every single leading indicator of a recession is flashing red. Deeply red.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It is a Bank of England day. We will declare victory with a smart set of guests across all this morning. And we don't have Governor Bailey with us, but if we had Governor Bailey with us, Lisa Abramowicz, it would be interesting, to say the least.
Especially because markets are pricing in 6% rates for the Bank of England by December. This is something people had not expected. And this really almost guarantees a recession. The question now is that inevitability anyway? And is this just a question of how much they can moderate the inflation in the process?
Over in merry old England, Adam Posen of the Peterson Institute taking the high ground with the Telegraph this morning. He doesn't mince words, and I'm going to go beyond the banner. On radio, it's simple. Posen, United Kingdom needs 6.5% raise. Dr. Posen makes clear maybe even higher than that. We say good morning. Jonathan Ferro on assignment.
On vacation.
Different island.
Is that
he
so?
migrated from Capri.
Yeah.
I can't pronounce it, but it's a very nice island. John Ferro not with us today, which makes us lesser because he's very good at the Bank of England. Well, as Americans try to keep up as well.
Well, can I just say, heading into the Bank of England, the appetizer, kind of shocking. What we got from the Norges Bank, we got from the Swiss National Bank, basically a surprise 50 basis point rate hike by the Norwegian Central Bank saying more is needed. You have from the Swiss National Bank, more is needed. A hawkish tone across the board, and it raises a question, what are central bankers still getting wrong? That inflation keeps surprising to the upside, and they're not getting a handle on it.
Today's a really important day. You don't see it in the headlines out there in financial media this morning, but there's some terrific tensions there. And the thing that Global Wall Street looks at, Linda Yu, thank you for pointing this out to me earlier on Twitter, the 2-year yield, the 10-year yield, we're now through 100 basis points. That happened a couple of hours ago. This is a huge bellwether. Let's take a moment of silence for Priya Misra, who absolutely provided leadership on this concept of OMG, we'll never get here. Ira Jersey, quite good at Bloomberg, too.
I just took a moment of silence. I think that was enough. I think I think that this is the key question here. Does this portend some sort of recession? And is the stock market waking up to what the rates market has been saying for a long time? Because yesterday you did not see a big move in rates. You did see, though, the third straight daily decline in tech stocks in the NASDAQ sector.
So when Lisa gets going on this, I turn to the Bloomberg terminal. And here's a dirty little secret. Pro tip, I use a trading envelope TE function, which sets up the standard deviation move in any series. So Bloomberg over here is going on about the stock market's pulling back.
Love you too, Tom.
And I'm looking here from 2 standard deviations. We've come back just a teensy-weensy amount of gloom.
Totally take your point. It's not a matter of gloom. Okay, hold on. Let's just correct the record here. I wasn't saying that this is the end-all, be-all. Suddenly we're going to get this massive crash. What I'm saying is you're seeing a bigger reaction in equities right now than you are in bonds. Bonds have already reset.
Yes.
Our equities now coming to the realization and trying to grapple with the implication of higher rates for longer, which is what the Fed and a lot of other central banks are saying.
Our goal is to speak to smart people. We're going to get to that in a moment. Lisa's got an important brief. Coming up in 10 minutes, the French finance minister, Mr. Macron, with an important conference in Paris and our friends in La Croix, in conversation with Bruno Le Maire. We'll do that in a bit. Shall we brief?
Yeah, we shall. And I should just note that if things hold as they are, we are seeing a 4th straight day of losses on the NASDAQ on equities, which would be the longest streak going back to early May. So this is one of the key questions. At 7 a.m., Bank of England rate decision. This comes as 2-year yields are around the highest in the UK going back to 2008, gaming out 6% UK rates by the end of this year. What does that imply for an economy that has been resilient, has avoided the deep recession? Seems tricky, though. It seems very tricky. Today, in terms of the economic data front, 8:30 a.m. initial jobless claims. We get Chicago Fed National Activity Index and current account balance. 10 a.m. U.S. existing home sales, which should be interesting given the resilience in that sector. Initial jobless claims ticking up. Is this enough to give people confidence that the labor market is loosening to the degree that they want to see it. Yeah.
Oh, please, go ahead. No,
Today
please.
is day 2 of Jay Powell, this time in front of the Senate Banking
Fed
Committee.
speech.
But yes, it's not just him,
look
though.
at
We
this.
also
Line it up.
Michelle Bowman, Loretta Mester, Tom Barkin, a whole host of speakers. We got a whole host of speakers yesterday. You're laughing, but we've gotten such different. Well, is it though? We actually got a whole host of speakers yesterday, and it was basically, the three bears of, and Goldilocks, the three bears of all potential rhetoric. You heard from the likes of Atlanta Fed President Raphael Bostic, let's stay on hold for the rest of the year. Austin Goolsbee, surprisingly hawkish, saying it was a really close call not to hike rates.
Yeah, I saw
and then
that.
Fed Chair Jay Powell basically towing the line, but with a little bit more of a hawkish tilt.
We got to be quick here because we got a very busy top of the hour. Hey, bring up that chart again, Amy, if you would. The four faces of the Fed speaking today. For all of you worldwide, this is the American difference within the Federal Reserve System. Each of these people is highly unique, and I'll go over to the right side to Mester, the mathematician, and Barkin, who is outstanding at business process, just as two ideas. We are rushed this morning, waiting for Bruno Lemire. Katrina Dudley joins us for a too short a brief this morning with Franklin Mutual as well. Katrina, are interest rates going to drive higher?
I think we've already got the indication from Powell that we have got at least another 2 rate hikes coming before the end of the year. So I think that you really need to trust the Fed. You talked about how smart the people in the room there are, and I think we agree with that if they're indicating that this was just a pause, and it was a pause that was done on the margin, you've got another 2 rate hikes coming.
What do you make, Katrina, of the fact that bonds have priced in the idea of a more hawkish Fed, hawkish central banks? Stocks perhaps seem to just be waking up to that reality. What's your view?
Well, have a look what's driving the stock market here. It's been this AI trend, which is really a deflationary trend if you think about it, because it is replacing a certain amount of functionality that was done by humans often with technology. So I think that you've got a deflationary trend that's been recognized in the equity markets and the performance you've had in the equity markets, whereas on the bond side, you've got a lot of fear here because the Fed continues to hike. They're hiking, as you say, because we keep seeing these very high inflation prints. So I think that the equity market is actually being very rational. We've seen in the last couple of days that sell-off, but I think that sell-off is just reflecting a little bit of the interest rate pressures towards the back end of the tech companies' earnings.
So you don't think it necessarily has legs, and you might even lean into this idea that certain sectors of the equity market act as a haven now, given that they have different factors that are underpinning some of the rally. Is that correct?
I think if you take a look at what is driving it, we don't have a lot of breadth in the S&P rally at the moment. You've seen a really big move in the AI stocks. But then if I look over at different markets, you look over at Japan, you look at the European equity market, the European equity markets, they're still facing the same rate hike cycle, but you don't have that lack of breadth and the market's still there and are holding up well. I think that we need to say that the economy is just not as interest rate sensitive today as it has been in the past. We also need to think about it in terms of where the absolute rates are. I think a lot of people have focused on the rate of change, but the level of interest rates that we're talking at a level that is manageable for companies, and that's what we need to focus on: manageable interest rates that are on a trend that people can predict.
The trend here is the key, Katrina. I would suggest there's a trend of stasis, healing, maybe a little price up, yield down. What if we cut the other way? What happens, for example, with the Bloomberg Total Return Index, global, U.S., whatever, where price gives way? What will be that behavioral response if we get price down, yield up?
I think if we take a look at what's happening with yields, we are really using yields in all of the central banks to fight inflation. So we've got to see some abating of that inflation. You showed the chart earlier. We're starting to see a little tick up in the initial jobless claims, and that's the other factor that the Fed is very much watching here. But everybody that we talk to, particularly around the manufacturing economy, which is the engine of this economy, it is the engine of what is being reshored here in the United States, is holding on to their labor. They're almost like looking at it as, I need to train the next generation. So I think as long as we continue to have that labor market strong, the Fed can keep raising rates in order to fight inflation without causing a significant deep recession. Maybe we have a small correction, but I don't think we're looking at having a deep recession here.
Katrina, thank you so much. Katrina Dudley, Franklin Mutual Shares. This is a joy because for America in this summer, it is where we are heading. Without question, everyone I talk to, there is only one destination, and it is Paris. It is stunning anecdotally to see the number of people migrating to France. Leading the way is Francine Lacroix from London at an important conference of Mr. Macron on climate and on the funding for poorer nations. She is in conversation with the tour director for Paris. He's on the bus telling us about the highlights. Bruno Le Maire, tour director this summer. Francine?
Tom, you couldn't be more right, actually. I have to say, everyone's here in Paris, not only because we have 30 heads of state here talking about finance and sustainability and how to tackle poverty, which is really spearheaded by the president of France, but also there was Fashion Week, and it does seem that every American actually in Europe has decided to descend on Paris. So congratulations, first of all, on creating so much buzz, not only around some important tackles, but actually Paris is buzzing. A little bit rainy today, but it's back with a vengeance. What are you trying to achieve at this conference? Are we talking about money transfer, debt forgiveness, or keeping the momentum to really try and do a new Bretton Woods agreement?
I think the key purpose is to keep the momentum and to have a new financial architecture for the poorest countries of the world. With President Macron, we don't want the poorest countries in the world to be confronted to a choice between fighting against extreme poverty and fighting against climate change. We want to provide all the financial means for those countries to be efficient in the fight against poverty and in the fight against climate change. This is the key purpose of this summit, and I think that the key point, the key purpose would be to define a new financial architecture for the 21st century.
Minister, are you frustrated that it's taking this much time? I know the Chinese premier is here, which is a great coup because we haven't actually seen U.S. officials and Chinese officials at this high level in a room together talking about these issues. But you've tried to push also voting rights in the IMF. How's that going?
Big things need a long time, so I'm not frustrated. I think that we are totally determined with President Macron to have a final positive outcome for this summit. I think that we are moving on the right direction as far as debt restructuring is concerned. We want to move faster, we want to move quicker. I think that we could have a positive outcome as far as the debt of Zambia and Sri Lanka is concerned. It is really quite good news to have the Chinese Prime Minister here in Paris today, talking with all the head of states, talking with the Secretary Janet Yellen. This is really, I think, a very positive outcome. We also have the new president of the World Bank, and we are defining a new role for the multilateral development banks, providing more money for the poorest countries. So really things are moving on the right direction, and the final outcome must be positive.
Minister, I imagine that in the corridors they talk about trade. They talk about the fact that Secretary Blinken was in China, the fact that we have President Xi with a rapprochement with the U.S. What does this mean for global growth?
I think it's good news because we all want to improve the relationship between the three continents, between China, the US, Europe. We are totally determined to defend our own economic interests in Europe. You know that the new principle, which is now at the core of the European future, has been defined by President Macron, and it is sovereignty. Sovereignty means that we want to defend our technological assets, our economic interests, while talking with China, but being aware that there is a necessity to really have all the necessary tools to defend our economic interests.
But, Minister, given the high inflation, interest rates rising, I mean, the economy is extremely complex. Do we need to attract, in Europe and in France specifically, more Chinese investments?
Yes, we are open to Chinese investments in France. We had yesterday a very fruitful discussion between Prime Minister of the Chinese Republic and the key CEOs of the French economy, and we made very clear that if there is any willingness of the Chinese government to invest more in France and more in Europe, for instance, on the EVs, on the electric batteries, we are welcoming those investments.
I mean, we have a lot of U.S. viewers at this time in the day. Would they worry that actually that investment that could have gone to the U.S. is going elsewhere, including Europe?
No, I think that, climate change means a lot of new investments in green hydrogen, in batteries, in EVs and so on, solar panels. So there is place for everybody. We should just be very cautious in the way we are defending our technological assets and our technologies, or key technologies. But anyway, the fight against climate change will pave the way for new investments and new innovations. And this is a very good thing that we have fruitful talks and constructive talks between the US, the EU and China.
Minister, how difficult is it to be in charge of finances of a country at a time where interest rates are going up? Inflation, of course, is going up, which leads to higher interest rates, but at the same time, you need to do economies because of huge deficits across the world.
It's a kind of fine-tuning, I would say, which means that...
Not a juggling act?
Yeah, no, just a fine-tuning, which means that the key priority is to get rid of inflation and to bring the prices down. This is the key priority for the household, of course. Then you have to take into account the necessity to come back to sound public finances. I just announced last Monday that we would cut in public expenses by 10 billion euros at least for next 2024. So this means that we are totally determined to come back to sound public finances and to stick to the path of reforms. We just introduced two key reforms, the reform of the labour market and, of course, the pension reform.
But given what we heard from the Fed and other central banks, do you not worry that interest rate hikes will be so severe that they'll almost have to crush economies, or at least put them in a recession to achieve their inflation target?
That's why it's so important to keep a high level of investment and a high level of innovation. If you want to avoid recession, you have to find the right balance between coming back to sound public finances and keeping a high level of investments in the fight against climate change and, of course, in defense, since we have war back on the European soil. This is this balance that we want to preserve. You know that we are in the process of defining the new rules for the European countries, the Stability and Growth Pact. We want those new rules to keep the right balance between investments and sound public finances.
Do they need to be more flexible?
We need flexibility, of course. We need rules. We need all the countries to abide by the rules. But let's be very clear. The key factor for the 21st century for Europe is to keep a high level of investment in innovation.
Minister, thank you so much, as always, for joining us. That was Bruno Le Maire, the French finance minister. And with that, Tom, I'm going to hand it back to you in New York. And we miss you in Paris.
Francine, thanks so much. We wish we were here. Lisa and I. John's on an Italian island somewhere. We don't care about what he thinks right now. But Francine Lacroix, thank you so much there. With Bruno Le Maire, and also I should point out, noted author. It is not often that a finance minister makes a splash. Mr. Le Maire is making in friction. I have to admit I have not read the books because my French is lacking.
Otherwise, you'd be reading them in French throughout the evening. Mon Dieu. I will say.
Mon Dieu, où est la bibliothèque? That's about it.
Right.
Thank you.
Well, I wonder if Paris is going to become the new Wall Street.
We're going to, well, this is a loaded question right now. There's a little momentum happening towards the Euro train from London to Paris. This bears careful watching in the coming quarters and years. Let's bring us back right now to the immediacy. We need to do a data check to frame out where we are in 40 minutes towards the Bank of England. As Lisa mentioned, equity's a little light. The VIX still 13.89. And Lisa, I'm going to go to the yield space. I'll start with a headline. 99 basis points. We printed 100 basis points. Massive and new curve inversion, as we saw a number of months ago, but yields creep up.
Well, on the front end, they're creeping up more than on the long end. That's that yield curve inversion. You're seeing the two-year yield at the highest level going back to March 9th, right before the banking crisis. What this tells me is that Fed Chair Jay Powell is correct so far, that inflation expectations over the longer term are controlled. When does that change? when we see all of these upside surprises to inflation and a Fed on hold, when do we see that other longer end creep higher in terms of yield price down?
Well, it hasn't crept higher because there's worry about economic slowdown, and that's a dynamic that we face right now and what we'll hear from the governor of the Bank of England here in a bit. But I also know this is the day the currency market began to adjust, and I agree with you, Lisa, it was off Norway and Switzerland as well. For those waking up in America, 3 banks acting today. 2 are out. And you know, to borrow from Peter Hooper, this was hawkish and almost hawkward, wasn't it, out of Oslo?
Well, maybe it was hawkward, but it certainly was clearer than what we got last week from the Federal Reserve. They are going to go again. 3.75% is the new rate. They are expecting to go further. They are further behind the United States. Still, inflation is a problem.
Right.
It is not abating, and that is the theme.
6.7% in May in Norway, and I believe that is a record high. The currency market breaks. DXY under a 102 is very important. 101.959. Yen gives way. Euro a 110 print. This is important. We're looking at 105, 7, 8, 9. Stronger euro out to 1.1005 right now. Confirmed through sterling 127.84 in this argument about 25 or 50 basis points. So much of the story of Europe and what we'll see from Governor Bailey here in 39 minutes is about energy. And it's not only the energy in America and maybe the better tone of West Texas Intermediate 7142, but far more what a leader of petrol costs in the world of the United Kingdom. Olga Kakova is expert at this, Deputy Director of European Energy Security, the Atlantic Council Global Energy Center. Olga, thank you for being so patient with us this morning with the French finance minister shoving him as well into the show. Olga, let me cut to the chase. How much is the war in Ukraine, the geography of a dam break, and other issues, how much is the war in Ukraine affecting continental and United Kingdom oil prices?
What happens in Ukraine does not stay in Ukraine. So any kind of instability, particularly the horrendous costs of the war, will have global implications on prices. So not just in Europe, and the risks and the uncertainty around the upcoming winter. So it's hard to pinpoint an exact percentage point link, but I would say that anything that's happening right now in the region and how well Europe is preparing for potential shortages and other unexpected events that could happen will directly impact the futures and other prices.
Olga, do we see a real shift in terms of diversification of energy sources in Europe based on what we have seen with Russia?
Great progress made on coal, great progress made on oil, natural gas. A lot of the questions are around how permanent this diversification is. Because as of right now, there are no sanctions on Russian natural gas coming into Europe. Russia self-sanctioned itself in terms of the exports. So the diversification so far, so good. There are some exemptions. There's some gas going into Europe through Ukraine, through Turkey, but much smaller quantity. The question is, how do we ensure that the supply security is permanent, that enough projects come online? We're seeing some in the pipeline for the next 10 years, but the question is, how do we ensure that new investments are coming online? And a lot of those are tied to the long-term contracts. And so that will be important to make sure that full 155 BCM of Russian, for example, natural gas gets replaced permanently.
You mentioned coal. You mentioned some of these other sources. We just heard our own Francine Lacroix speaking with Bruno Le Maire of France, the finance minister over there, talking about ESG, talking about climate change. Has the fight to fight climate kind of ended, or not ended, but been postponed as people look to energy security first and foremost? In other words, has there been less discussion about that and more discussion around the immediacy of fueling the homes and the cars and the businesses of the European region?
I think we just look at this conversation differently now, where you don't have to pick one or the other, where you don't have to just say, we'll focus just on climate or just on energy security. The two are now permanently intertwined. So when we talk about a secure, clean energy future, we have to figure out how to do both. A lot of the solutions actually contribute to both of these areas. For example, clean energy solutions such as heat pumps that provide for more efficient ways to manage your home temperatures. They both contribute to decarbonization and less reliance on energy that you need to use at home. At the same time, clean energy production at home, that once again is less reliance on energy imports into your country. But there are other supply chain constraints when we talk about a robust build out of clean energy sources and making sure that those supply chains are diversified so we don't face the same problem as we have with our fossil fuel reliance.
Olga Kova, thank you so much. Greatly appreciate it with the Atlantic Council Global Energy Center this morning there and some of the issues we're seeing in hydrocarbons. It seems like two worlds almost. We've got cheaper oil here. We're celebrating $71.46 barrel, and there's that unique American thing. We got to drive. We got to have our trucks. We need Madison Avenue completely clogged. We need Fifth Avenue, as yesterday, jammed from 102-ish all the way down to 48th Street. It was like before the pandemic.
This is one of the most confusing moments I can imagine in the fossil fuel space, in part because China has massively shifted to electric vehicles. So the potential demand there has shifted in terms of transportation versus usage of fossil fuels. And around the world, I mean, that shift is sort of uncertain in terms of how much it's taking demand away from the oil space.
The tension here this morning, I want to make clear there's huge market tension out there with currencies on the move and really new inversion. Mark Chandler on short notice scheduled to join us here in 20 minutes, 6:45, leading into BOE with all of his foreign exchange expertise. And Mr. Chandler this morning, Lisa, he minces no words. Higher for longer is a shift for the gentleman from Bannockburn.
And we have seen that pretty much across the board in terms of the rhetoric out of the central banks in Europe, as well as Fed Chair Jay Powell. He doubled down on that yesterday, and we'll hear it again today.
Very interesting time here. Futures at -9. We're very interested in bonds and foreign exchange. In the 8:30 hour, our Maria Tadeo in conversation with the Prime Minister of Ukraine. Good morning. Bloomberg Surveillance, good morning, everyone. The next 30 minutes is going to be worth watching if you're part of Global Wall Street. Also, I got to straighten out my bow tie for radio. There we go, much better. We have coming up, Simon French will join us in moments, and then Mark Chandler will join us on the astrology of the moment, and then we move on to Bailey of the Bank of England at 7 o'clock. Chandler, French, and Bailey, really looking forward to that here, getting out here in 30 minutes to an important and mysterious Bank of England meeting. Lisa, what's the biggest mystery for you?
Just how much they can hike before they torpedo the economy.
Like 25 or 50?
In a much more difficult way.
Know.
Well, the 25 or 50 is going to be interesting, but then the follow-on in August, are they going to follow up with a 50 or a 25 basis point hike? What is the threshold given the inflationary pressures that seem to be much higher than expected?
When the belief changes, the market changes. I'm going to pick on Euro 110.06. This is demonstrably stronger Euro in the last 72 hours. I'm also going to go to the 210 spread out at 99 basis points is I think almost on the edge. Is shocking for Wall Street. Lisa, what else do you see?
Well, I'm looking at the pound. I'm trying to understand just how much rate hikes at this point
127.85
will end up actually making it weaker. And if you look at the pound versus the euro, that's the cross that I'm watching at 116, and it's been sort of fading. The question here is, at what point does growth expectations overtake the expectation for further rate hikes? That's going to be important.
Sterling dollar is called the cable. Euro sterling, Francine Lacroix calls a Ferragamo.
Okay.
It's a Ferragamo, just so you know. We're watching Euro sterling. To Americans, this is sort of foreign, but actually the adults like Simon French look at Euro sterling.
So we've got a half an hour until the key Bank of England decision. And this is really the concern. Hot inflation may force it to end up with a 50 basis point rate hike. Jeff Yu of BNY Mellon writing, quote, there may yet be another push for the BOE to front load the pain, reluctantly to engineer a hard landing in the hope that it will be short. There would seem no good options, but on balance, we do not see a 50 basis point or even 75 basis point move this week as the, quote, least bad. And this is the tension, Tom. If you front load the hikes, if you induce some sort of recession, do you allow it to be shorter, or are you just inducing pain that might otherwise be avoided?
For Global Wall Street now, a brief here, 27 minutes away from this key Bank of England meeting. Simon French, chief economist, Pamela Gordon. Simon, let me just get the knitting out of the way. 25 or 50 basis points?
25 for me, but I would associate myself with the comment that there's no easy and there's probably no good decision that the Bank of England has to make in 20 minutes' time.
In honor of Bruno Lemire, I'm going to go Cartesian on you, and it's real simple. Is this a y-axis study or an x-axis study? Adam Posen in the Telegraph this morning talking about 6.5%. That gives me a level y-axis move. Or is it about the x-axis moving out in time?
I think it's more an x-axis moving out in time. Tom, I tried to do my homework ahead of this interview. I know you want your historical reference points here, and Alan Blinder's seminal paper back in 2000 in the American Economic Journal about central bank credibility. Why do we need it? How do we get it? The Bank of England, unfortunately, and I say it's unfortunate because it's got the market to where it is today, has slightly blown up its own credibility in terms of its communications and some of its policy decisions through the last 18 months. And as a result, it finds itself with the market split today on what to expect, which is where no central bank ever wants to be. And that credibility point eliminates the idea that the bank could pause today and follow the Fed. Why? Well, the key transmission, and this is to Lisa's point about what this does to the economic cycle, is we know that only about a quarter of the rate hike impact impulse has passed through into the real economy so far. They should be able to fall back and say, we've done 440 basis points of hikes. We still see 3/4 of that to crystallize and come out through the mortgage refinancing cycle, but they haven't got the credibility to do that.
Simon, it seems as though originally people were talking about inducing some sort of hard landing to make the whole time frame less long, right? Less painful overall. Is that still in the zeitgeist, or are people moving on to this hope of a soft landing that seems to have overtaken most policymakers in the United States?
All right. So, look, I don't ever see, and maybe this is because my background as a labour market economist, is what a hard landing, even if you engineer it short and sharp, presents you in terms of a better long-term economic outcome. The scarring impact, the hysteresis impact of labour losing its attachment with the labour market, and we saw both sides of the Atlantic, the impact of the pandemic of people being removed from their place and of work, their profession, that has a scarring impact in terms of labour market participation trend growth. And therefore, personally, I go back to your question links nicely with Tom's first one. Let's try and elongate this through a combination of comms and explaining the transmission mechanism rather than going hard, rather than going quickly, and potentially amplifying that scarring.
I keep thinking about the Mohamed El-Erian comments yesterday in a Bloomberg opinion piece where he was saying that, yes, the UK is slightly idiosyncratic in their inflation. However, it is a warning to the rest of the world, in particular Europe. And I'm wondering, do you see it as the same? That, yes, there are unique features of the inflation, but that is something that you're seeing in places like Norway, in places like Italy, in places like Spain. And this is something that central bankers can't ignore.
I think that's absolutely right. I mean, one of my recent notes decomposes the UK inflation picture and why the 350 basis point spread between headline CPI at the UK level and the G20 average is almost entirely a composition of the energy market and the outsized impact of European gas prices, which of course took their cue from the war in Ukraine. But to your point on spillover second-order effects, not just in-border but cross-border and lessons learned, I think the fact that it has been such a seismic move in the price level, we should expect second-order impacts to be pretty persistent. There were a lot of forecasts out there. We're going to get this immaculate deflation at the start of those forecasts were put out at the start of Q1 2023. I never bought those. That's not the history of inflation. I don't think it'll be any different in this cycle.
Look, Simon, where we are, and the answer is we end up embedding, in the case of America, the Biden stimulus into our prices, into a permanent level, a permanent lift in inflation. Is that what we've wrought here, where we're just rationalizing out within the markets in quarter to quarter, central bank meeting to central bank meeting, that we're just embedding in a higher one-off level of prices?
Yes, I think we are. I think part of whatever one thinks of the strategic narrative around the Inflation Reduction Act, the reality is you are transmitting economic output, economic activity from geographies where the price point is more competitive to a price point that is higher, is less competitive. Now, you may argue, as many on Capitol Hill do, that there are strong strategic reasons for doing so, and I'm not going to wade into that debate. It's one of the privileges of being in my role. I don't have to get involved in the political debate. But I would say from an economic standpoint, we are embedding a higher price point for every geography that is trying to actively onshore, take control of its supply chains. There are, as I say, good, strong strategic reasons, resilience reasons for that, but let's not pretend it isn't doing a sustained, elevated move in the overall price level.
Simon French, please stay with us. With Panmure Gordon here, we welcome all of you on Bloomberg Radio and Bloomberg Television. We're 20 minutes or so away from an important Bank of England meeting, made ever so important today by the shock from Norway and Switzerland of a reset to higher interest rates as well. Lisa Abramowicz and Tom Keene, Jonathan Ferro on assignment with futures at -12. Yields are higher, dollar weaker. Lisa?
Yeah, and what we've seen so far this morning, just to bring you up to speed, first we had the Swiss National Bank coming out and raising rates by 25 basis points, saying that most likely further tightening is necessary. Then the Norwegian Central Bank coming out with a surprise 50 basis point rate hike, also saying more is needed. And now we are about 22 minutes away from the Bank of England. Simon, as we move forward, do you have a better sense of what we are going to? Is this going to be the low-rate regime that we knew once we get inflation under control? Or is it increasingly apparent that this is a new paradigm and one that will really have much greater implications for assets around the world?
So I don't think we see a reversion back to the pre-COVID level of monetary policy. The last time I was on the show, in fact, it was very shortly after the IMF published a blog showing some of the structural drivers as to why, when we're through this surge, we may see a tack back towards a R star being lower than the terminal R. I think you see something of a tack back, but one of the things I said when I was appraising that IMF research blog was there are some big decisions on trade, on protectionist, the length of global supply chains, which are going to frame a lot of that medium-term, long-term outlook. And they're by no means predetermined. And all the political rhetoric I see sees that reinforcing those shorter supply chains, elevating the price level, and therefore R star does incrementally move higher.
Simon, before we let you go, I have to ask how much you're starting artificial intelligence as an economic input in terms of productivity, in terms of offsetting some of perhaps the frictions that we will see continue in the supply chains and in the workforce.
I am studying it. I don't profess to be an expert. A lot of economists overnight reinvent themselves as epidemiologists during the pandemic, or in the UK context as trade economists during Brexit. I don't suddenly, and I don't want to pretend I'm now an AI expert, but there are some decent lessons from history here in terms of the productivity potential of new technology come in and allowing a reprofiling of activity away from quite clerical, repetitive activities into more value-added activities. It's a strong empirical basis, but the problem is sometimes, actors in the market, including government actors, have a different idea. And so would I take what we've learned in the last few months and upgrade my productivity estimates? I think I'm going to need to see how that intellectual property is integrated into the wider economy before I make those calls.
Simon French, thank you so much, with Panmure Gordon as well. Before this Bank of England meeting, and an important meeting for those in America, we put more weight on the Fed because we're based in New York and American and all that. But guess what? This is an important meeting. Microdata, and I didn't know this, Norway's a lot about salmon. Like, you have a beverage and you have salmon and crackers.
Yeah.
You're familiar with this. Norway's salmon up 26% from the beginning of the pandemic, and it's a real leg up from the late winter of 2021 in price. I mean, just you think about a smaller nation like Norway, far less people than I think what we perceive. And the answer is this inflation is tangible, and that's why they have to act.
Well, and you're seeing this also in the housing market. A lot of people saying that it's more concerning in some of the Scandinavian countries that have seen real price inflation. This, to me, is the concern. It's idiosyncratic, yes.
It's not.
But it's idiosyncratic
exactly,
for this nation and this nation and this nation. At what point do you start putting it together? And yeah, there are different features for each of them, but at some point you have to start wondering, what are we missing?
Well, it's not so much what we're missing, but I totally take your point. I mean, we use Turkey as the arch idiosyncrasy, 23.55 on Turkish lira, some stability there for Mr. Simsek. But I do take your point. There's a point where this and that all coalesce together into what Adam Posen was talking about in the Telegraph today, which is just a higher set of inflation.
By the way, have you ever had gravlax and lefse and some of the other Norwegian delicacies? Lefse is the bread.
I've had some of it at gunpoint, but yes.
Gunpoint.
And
Swedish
lutefisk.
too. Anyway, moving on.
Yeah.
I do want to say that one thing that is different about the U.S. is that the fiscal impulse is less clear. And I think that that's also what we're looking for as we talk about the recovery in Ukraine and how to deal with some of that. In the U.S., meanwhile, there still is quite a big fiscal impulse. It's starting to get withdrawn with the student loan deferrals. But this, to me, is the big mystery. Do you still have, working at odds, the fiscal side and the monetary side?
Yeah, I didn't listen to a word you said because I was imagining the Norwegian finance minister, the Norwegian finance minister sending team surveillance, one of those wooden boxes of salmon and all the other stuff you mentioned.
I
from
love
Norway.
that. And the berries, although that's more Swedish. That's more the lingonberries. That's more Swedish.
Okay, Velderie, Velderie.
I lived in Fargo, North Dakota, of course.
Yeah, that's what'll do it.
Yeah.
Whammo, Fargo, North Dakota, taken in the Scandinavian view. That is a view of inflation. We will hear from the Bank of England and, of course, comments from Governor Bailey. I don't think he'll declare victory today. Mark Chandler next. He sees rates higher for longer. Good morning.
I am monitoring very carefully the possibility of additional tightening from the banking sector with respect to credit. It represents a downside risk for the economy, and I'm watching that very carefully.
Really, excuse me, gasping here. Interesting. It's the lox and bagels this morning from Lisa. Interesting conversation there with the governor of the Federal Reserve, very much thought to be the next vice chairman, Philip Jefferson. And it's interesting to see, and as Lisa mentioned today, a set of Fed speakers. This is after what we're going to see here in 14 minutes. But I'm sorry, the Fed speakers today could really add value here to the longer of all this discussion.
Fed Chair Jay Powell said almost all Fed members wanted to raise rates further, thought that would be necessary by the end of the year. We found one who didn't, Raphael Bostic. He seemed to want to keep things on hold. So let's find out who the dots are, who wants to do what, and what that means in terms of some of the thinking behind the rationale.
We're before the Bank of England meeting. It's an important meeting. I'll not mince words. I wish John was here. He viscerally does it better than Lisa or I do. But it's going to be an interesting meeting, to say the least. And what's important about it is a linkage of equities and, more importantly, bonds, currencies, and commodities. Simon French just joining us, and now Mark Chandler joins. Mark Chandler is truly expert on these foreign exchange dynamics, chief market strategist at Bannockburn this morning. Marcus, what's sterling do here? I mean, Brexit was a 116 sterling. We have a new, resilient, stronger sterling. What is your sterling call off this meeting?
Thanks. Good morning. I think that if the Bank of England delivers a 25 basis point rate hike, sterling may sell off. I'm looking at the swaps market, pricing at about a 1 in 3 chance of a 50 basis point hike. Like Norway delivered, 50 basis points. I think sterling could rally. But I think the real issue here is the trade-off. It's not so much, I think, the trade-off as far as 25 or 50, but I think it's whether with this higher than expected inflation number we saw earlier this week, whether Chancellor Hunt's perspective that a recession is worth the risk of getting inflation under control is really the key trade-off here. I think that's what we'll see. I think the UK, the Bank of England, is committed to lowering inflation, and I think they're willing to risk the recession to do so.
Mark, there is real tension in the FX market about whether further rate hikes actually mean a stronger currency or whether it incurs some pain on the economy that actually infers weakness. When do we cross that threshold? How is that balance changing as we head closer to a sort of a tipping point, certainly in the UK?
Yeah. I think that we see this, Lisa, in the yen. The yen is really the underperformer this year, and partly I think this is a question of monetary policy divergence. At the same time, last week when the Federal Reserve said the median dot pointed to a 50 basis point hike this year still, 25 basis point hikes, the market doesn't believe it. And I think that since the Federal Reserve met last week, the dollar has actually weakened. We've got the euro today above 110 for the first time in a month. We've got the Canadian dollar at its best level for the year. And so I think that the market's doubt. Remember, a few weeks ago, the market was pricing in cuts from the Federal Reserve this year. And now it says to the Federal Reserve, when the Federal Reserve says 50 basis points, the market's saying unlikely. And so I think the dollar has suffered for that. So I think we're in that mix that you're saying now, that rate hikes don't necessarily mean a stronger currency, but the market's got to have confidence in the central bank's forecasts.
Mark, you don't mince words. You say, and we talked to Simon French about this, the whole solution here for banks is less the level and the move up down, but you just say it as clear as a bell. They're going to go out longer. Frame longer for these central banks. Are they going to hold rates where they are, a little bit higher, for quarters, or do we go into 2024?
I think that's an important issue. And I think what's happening is that we're at the tail end. Whether you're looking at the Federal Reserve or the ECB, Bank of Canada, Australia, we're at the tail end of the tightening cycle. Whether it's, many of us, including myself, thought maybe it'd be done by the middle of the year. And now it seems like we're going to extend into later this year. Bank of England might be the exception. Depending on what they do here today, the market's pricing in rate hikes into early next year. But still, when you think about the Bank of England or even Norway, they began tightening before the Federal Reserve. And many people were critical that the Federal Reserve was slow out of the box. But here's two central banks raising rates before the Federal Reserve and having to raise rates more aggressively now because inflation is really higher. Both the UK and Norway had new cyclical highs in their core rates. We know that the U.S. rate is slipping, the headline rate faster than the core rate. But I think that's the general direction, is that we're talking really about a few more months of tightening from, I think, the major central banks, with the Bank of England the exception on one hand, and the Bank of Japan the exception on the other hand, just being very slow to tighten.
Mark Changler, thank you so much. With Bannockburn today on short notice, briefing us before this Bank of England meeting 8 minutes away. Moments ago, and I believe we're the first to report to you on the mid-year outlook for Kalanovic, Kasman, and the team at J.P. Morgan. And they don't mince words. They're looking for a GDP slowdown. I'm verbaling this to you on radio and TV. United States down 0.8% from 1.5% potential GDP. They look for a Q4 of 0.7. Same idea in the United Kingdom, 0.7. Japan does a little better. China, 5.8%. And critically, they say disinflation will be incomplete. And Lisa, that perfectly encapsulates the frustrations that we see over the last 24 hours with Norway, with Switzerland, and what we're going to see in 8 minutes with the Bank of England.
So here's the question. What does this mean for markets? And they talk about the frustrating read-through in markets that has not been logical. They talk about how volatility is abnormally low given all of these crosswinds and the likely higher inflationary outlook. And they don't necessarily see a massive surge in the VIX because there are these technical pressures ongoing. There is this sort of key question. And as I dig through this, I want to hear what they have to say. Are tech stocks the new safety plays in a higher inflationary environment? This is the oddity of the past couple of weeks that is absolutely turning on the head the logic heading into this year. Does this really have a new promise with AI that somehow makes these stocks immune?
I'm not there. You just busted my chops with this. But the answer is, and we're going to look at the Standard & Poor's 500 here from the J.P. Morgan mid-year outlook, and they go from 4410 where we are right now to 4200, down 5% there, and so that's pulling into that equity market. I don't have it in front of me, but I would call 4200 now almost center tendency. You think I'm off on that?
Well, 4200 is almost conservative now. That's almost bearish considering where the sea change is shifting to 4500, 4800 and beyond. If we're talking about 4200, that means declines from here. That means chop, and that means potentially shifts in leadership.
Right now, we're going to get a preview here on the Bank of England. Joining us now with her perspective, and she's really been studying the makeup of this committee, is Lizzie Burden. Lizzie, I look at the Telegraph and Adam Posen taking the headlines this morning, looking for a 6.5% level. And that speaks to the oddity of your bank taking in those pesky foreigners. Is Catherine Mann the Uber hawk today between 25 and 50 basis points?
Tom, she might not be alone. She might be joined by Jonathan Haskell. He's been pretty hawkish recently, and some economists are seeing a three-way vote split with those two at that end. And then at the dovish end, Silvana Tenreiro and Swati Dhingra constantly emphasising this lag in monetary transmission, and then the rest in the middle, the 25 basis point gang. But as you know, Tom, when there isn't a press conference, when there isn't a forecast, sometimes the bank tries to communicate its messaging through the vote split. So look out for that, and I'm sure markets will be too.
Lizzie, thank you so much. We'll look to speak to you here in a number of minutes in England on the Bank of England. Futures deteriorate, -14, Dow futures -113 as well. And yes, I'm looking at the 2-10 spread, 99 basis points. It did breach 100 basis points here earlier this morning.
I'm watching two-year yields over in the United Kingdom, which are hovering right around the levels that they were right heading into and out of the 2008 financial crisis, 5.05% for the 2-year. And could that go substantially higher if the gaming out of 6% rates in the United Kingdom becomes more of a reality after this meeting?
John gets the dissent at the Bank of England viscerally much better than you and I do, but I think we can look for some fractiousness today versus the quiet that we get from Jerome Powell.
And not only would it be something, it's not only is it not tense, it's needed given the uncertainty of any good decision. We heard that from Simon French. We've heard that from many others. There really isn't a good option for them here today. They're hiking into weakness. The question is, do you want to torpedo the strength quicker in order to get inflation under control?
And it's going to be interesting to see the 2-year yield 4.75%, the 10-year U.S. yield 3.75%. And again, not historic, I can't say that, but rounded up, 100 basis point curve inversion right now. Dollar weaker, sterling 127.86. In moments, an important decision by the Bank of England as they see record high core inflation. Stay with us from New York, Bloomberg Surveillance.
The Fed has been trying to talk this market down, and in the end, the equity market has simply ignored it.
Different sectors of the economy are performing in different ways.
The market's gotten more and more selective.
I think we can all agree that the economy is a lot less interest rate sensitive than we thought.
Every single leading indicator of a recession is flashing red, deeply red.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. An historic moment on the independence and the certainty of the Bank of England. They go against consensus and raise rates 50 basis points. The vote was 7-2. And Lisa, you see it immediately in sterling on 127 out to 128.26.
Some of the commentary saying the full impact of rate rises will not be felt for some time. Seeing the UK economy stagnating in the second quarter, but growing in the third quarter. How does this cohere with this idea of more aggressive rate hikes? The 7-2 split, very interesting at a time when the vast majority of commentators thought that this would just be a 25 basis point hike. They went against it, took a page from the Norwegian Central Bank and went 50.
And I think that's very important. The combination here today of the action of the Swiss, what we saw in Oslo, and now what we see in the United Kingdom is, with respect to the Bank of England, Lisa, the lesser banks saying enough, we're going to act.
They say inflation is expected to fall significantly this year. They do say, though, that further tightening will be needed if signs of more persistent inflation persist. Ongoing feeling that there was some sort of unanimity with respect to the importance of hiking rates. Nobody on the committee thought that it was important to keep rates where they were, not raise at all. All of this coming together to give you a sense of higher yields for longer, and that is what we're seeing certainly in the UK bond market.
We're going to go to Lizzie Burden here in a moment, but Lisa, right now I want to look at the single phrase. And each bank has their own set of headlines that roll out in the Bloomberg 20, 30, 40 headlines. Euro's very much time, 2025 and all that. Here on the emotion, and perhaps in the letter to the Chancellor from Governor Bailey, the bottom line is a tight labor market. I would suggest, Lisa, over the last 18 months, that's collectively what the central banks have gotten wrong.
What you've seen over in the UK is wage increases far above what we're seeing in the US. I believe it's around 7.5% year over year. I was reading about this. Lizzie, I'm sure, can correct me, but that is far above what we're seeing in the US of about a 6% rate. And it starts to raise this question of a wage price spiral when there is more labor pushback, when there are strikes, when you're seeing that in a visceral sense pretty much across the nation. I don't know what they can do. Is this structural, and how much are they going to comment on this in this meeting?
To give us perspective from Queen Victoria Street, Lizzie Burden. Lizzie, were you shocked by this 50 basis point move?
I was, markets will be, and economists too. I was speaking to economists just before this decision. One of them said that if they went for 50, it would reek of panic, but they've done it nonetheless. You've got two dissenters in Swati Dhingra and Silvana Tenreiro, and it's a shock even that they're not holding, that they are hiking anyway, when they have been repeatedly emphasising the lag in monetary transmission. As you say, it follows the other central bank this morning. They're really trying to get a grip of inflation after that fourth inflation surprise yesterday, and the tight labour market too. The risk becomes about recession. Now, Bloomberg Economics research showed that if rates get to 6%, you could see a recession here in the UK. It's difficult for the Prime Minister Rishi Sunak when his number one priority is fighting inflation. But if it takes a recession to do that, one of his other priorities is growing the economy. Can he hit both of them? Looks more doubtful. But of course, this is more pressure for mortgage borrowers, so it ramps up the pressure on the Chancellor, Jeremy Hunt, to do more to help people who are going to face even higher risk of repossessions now, but he doesn't want to go against the Bank of England.
Well, Lizzie, there's a confusion here in the forecast that we saw from the Bank of England today. They see stagnation with respect to the UK economy in the second quarter, but a bit of a rebound in the third quarter. Is that coherent with 5% rates in the region and potentially 6% rates as soon as December?
Well, if you look at the SHOK shock function on the terminal, as I say, 6% rates is where Bloomberg Economics sees a recession being triggered. And now that we've already got this half-point hike today, I expect that markets are going to be pricing an even higher peak rate. They were seeing 6% before, some traders seeing 6.25%, so you can expect those bets to go up.
Lizzie, I met at the IMF meetings. I had a wonderful panel, including Tenreiro of Argentina, who's visiting at the Bank of England and exits soon. From where you sit and studying this each and every day, is this a hawkish or a dovish Bank of England?
As I say, when there isn't a press conference, the bank can communicate its messaging and its future path through the vote split. So clearly, it seems to me, the bank is trying to communicate that this is a hawkish, they're being hawkish through the vote split. The fact that none of them have gone for a hold is that message all over. But remember, this is Silvana Tenreiro's last meeting. She's going to be replaced by Megan Green from your side of the pond, Tom. And she too has been making hawkish noises, unlike Tenreiro. So perhaps it could be even more, we could see more hawkishness in August.
I will suggest that Megan Green has not been making hawkish noises on Bloomberg surveillance. We've been scrupulous not to jeopardize her path to the Bank of England. Elizabeth Burden joining us this morning from Queen Victoria Street here in truly an historic moment. There's no other way to put it. As a sideshow, moments ago, the Turkish Central Bank says tightening will be timely and gradual. Lira pops out to a new weakness over the last number of days. A sideshow, but nevertheless idiosyncratic and important, as Lisa would mention. Right now on this story, and for those of you in America, we do have a deterioration in futures off of the Bank of England announcement, maybe fractionally looking towards a more hawkish tone from the American Central Bank. We have Jay Powell again today, right, Lisa?
10 a.m., yep.
10 a.m. We've got Jay Powell. Maybe we'll get some color there on what we see from Switzerland. I'll get it. It's an S country. Switzerland, Norway. I'm doing well this morning. Thank you. Switzerland, Norway, and now the United Kingdom. With perspective, Sri Kochagavadan, senior research economist at Aberdeen. Sri, I'm absolutely fascinated by how you link together the actions of Switzerland, Norway, and now the United Kingdom. Suddenly, is it a hawkish tone in Europe?
I think this is clearly a hawkish tone from the UK and from Norway as well. Clearly, this they've surprised the markets. Norway this morning surprised with a 50. There was running into this, there had been quite an intense debate. There were question marks about whether there would be a 25 or 50 basis points from the Bank of England, also for the Norway as well. But clearly, this is a surprise. And just running through the statement quickly, the reasons are very clear. This is something that has been signaled actually within the speeches for some time. It is the core services inflation, which has been incredibly strong. Yesterday's data really did help trigger that debate about whether 25 or 50 would be necessary. This is really a very, very strong picture for the UK. If you compare the UK with other developed markets and look at that wage number, it is really standing out with an increased wage pressures there, while other countries are starting to see a bit of a stabilization or a rollover. If you look at other European countries, if you look at the Fed or the US, UK really stands out from that core services and wage pressures angle.
We're watching the pound strengthen in response to this surprise 50 basis point rate hike from the United Kingdom, which is a departure from what we saw for the Liz Truss era. Sri, how much is this a positive sign that shows people believe that economies can withstand higher rates to a much greater degree than they thought just even 6 months ago? And then it really gives confidence that you can fight inflation with higher rates without creating some sort of deep recession?
I think that's going to be very challenging, to be perfectly honest. I think that, the fact that we've moved to 5%, markets are pricing in 6% the last time I looked earlier this morning. This is really triggering a recession. Now, monetary policy works with long and variable lags. That's something we often hear. And what we're seeing here is that we are, monetary, financial conditions have tightened significantly. There is some question mark whether the Bank of England will raise as high as 6%. There's definitely further to go, potentially, but 6% would be triggering not just a recession, but a much more severe recession than economists are currently forecasting. Now, we do feel that the monetary tightening will trigger recessions in a number of different countries. I think a soft landing is very difficult, and unemployment rates are starting to nudge higher, but the tightness in the labor market is very worrying in that the longer the recession is delayed, the more severe we could see in terms of rate hikes and recession later on next year.
Sri, inform our American audience, which we understand the dynamics of a fully employed Ohio or Kansas versus challenging city unemployment rates, perhaps in America. The perception we have is London booming, the South blooming. I'm thunderstruck at double-digit unemployment in Aberdeen, way up in the northeast of Scotland. How uneven is this debate on monetary policy across the United Kingdom? How much of the United Kingdom is truly in recession right now?
I think there is a regional issue, and that's something that really needs fiscal measures to really address. Now, from a monetary policy perspective, the Bank of England are limited to what's happening to the aggregate inflation rate, what is their target, and how do we get back to the target? So the regional divergences is very difficult to tackle without fiscal measures and structural policies to target those issues. Now, if we think about what's happening in terms of a recession, we're not quite in a recession yet. We've seen some weakness in data. For Q2, we have a number of different drivers. We have strike action, particularly in the healthcare services. We had an extra bank holiday for the King's coronation. All of these issues will lead to some weakness in activity, but that's not necessarily a recession just yet. What the Bank of England need is for the economy to cool so that some of the imbalances that are driving inflation start to ease, and you start to see more sustainable deceleration in that core services area, and we're not seeing that yet.
Okay, Sri, thank you so much. Just really outstanding. Sri Kotchagovindan with us with Aberdeen, this truly historic moment and gyrating moment for the United Kingdom. Sterling 128 to 127.55. The Standard & Poor's 500 down 0.3%.
If you're just joining the program right now, we've been talking about how the hawkish tilt of central banks around the world has gained steam and will continue to do so. This one, though, you mentioned this in brief, Tom. Turkey raising rates, doubling interest rates, goes against all of the ethos of Erdogan over the past couple of years. This is the first rate hike going back to 2021. And this, to me, really highlights perhaps this is a recognition of a policy that failed, that they thought cutting rates would actually curtail inflation that has absolutely spiraled out of control. And now perhaps they're about facing and saying, OK, central banks, the rates are going to rise from 15% to 15% from 8.5%.
This is a changing of the guard for Erdogan. And, you know, I've read a fair amount about this when I was in Turkey, a fair amount for Bloomberg. At least it's what I would call early Erdogan. And then there was middle Erdogan. And recent Erdogan has been very geopolitical, obviously, with a huge distraction and import of where they are to the Black Sea and the war in Ukraine. But you wonder if this is a new Erdogan, as personified by Simsek, Mehmet Simsek, the new finance minister, hugely esteemed by the Western financial community, and also a new head of the central bank, again making a huge splash here. And so I think, first of all, I think that we need a road trip. Surveillance in Istanbul, I think, would work.
Yes, I would. A food road trip.
But, well, it can be a food road trip as well. But I think this is important, and you see it in Lira of 23.60.
I think you're spot on about the new leadership. Formerly of Goldman Sachs, of First Republic, of Princeton, heading over there.
Yeah.
Maybe this is a real sea change, at least for the moment, in terms of monetary policy.
A sea change at the Bank of England, too. They surprised and increased rates sharply, 50 basis points. The press conference of the governor of the Bank of England later. Stay with us. This is Bloomberg Surveillance.
We never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
The chairman of the Federal Reserve speaking within the last 24 hours, and this before action by Switzerland, action by Norway, and now abrupt action by the United Kingdom to get their hands upon inflation. We're ripping up the script this morning for Bloomberg Surveillance because there's a lot going on here, to say the least. We need an update on the break. Bramo looking at cable stronger, as you'd expect, higher interest rates, more attraction. Money comes in to buy merchandise for the Abramowicz family on their next trip to London.
Stop projecting.
And then it gave it back. 127.61 is not a small matter.
It's sobering, because what it means is that people are looking at an outsized rate hike and possibly more as hurting the economy, as not necessarily being supportive for the longer-term prospects for the United Kingdom. This is not what the central bank wants to see. There were no good options, and what this highlights is this isn't the necessary, obvious solution.
Way out front on this morning was Kit Jukes of SocGen in his morning note, taking the Clint Eastwood path. He talked about the good, the bad, and the sterling, and that it is, if you raise rates, it's good for your currency until it's not. And you wonder if that's where we are.
Right. And how much do we see this in other economies as well at a time when you have these two tensions? Rate hikes good for the currency typically if it kills inflation, but slower growth bad for our currency. And when that starts to take over for the hawkishness, then central banks are between a rock and a hard place, hiking into weakness. And that's where we are in a number of places.
Oil, $70.90 gives way by $1.63. Maybe that's some of the recession slowdown. Angst out there, dollar weaker. Again, we're monitoring sterling closely before Governor Bailey's comments, 127.64. It is a political discussion always with Daniel Clifton. He's head of policy research at Strategas. It is a Baird company. But with Dan Clifton, just because of all that's going on in the international space and from Chairman Powell, Lisa wants to go issues. Dan, I'm going to go just simple, inflation. In your world, is inflation just simply what's the price of a gallon of gas?
Absolutely. In politics, that's exactly what it is. If you look at the University of Michigan consumer expectations, inflation expectations are coming down, largely tracking with the price of gasoline. And Tom, I think just generally, though, you've seen a pretty dramatic decline in inflation in the United States. We were at 5% a month ago. We're likely going to end June at 3%. To move from 5 to 3% is an enormous move down, and it shows that there is progress being made on the inflation front, and it's happening faster in the United States than maybe in some of these other areas. And that's why these central banks around the world have to continue to tighten. But we have a money supply contracting here for the first time since the 1940s. It is having the effect of getting inflation down, but it's raising economic risks, and that's what we're starting to see.
Are the politicians aware of those economic risks? When I look at a given unemployment rate in Kansas or Ohio, I'm looking at 2.x% unemployment. That doesn't sound like a recession.
So I think there's some hope here and hope is not a strategy, but there's some hope here that you can actually get inflation down and employment is remaining strong. The problem with that is that you're now in the middle of a pretty big liquidity drain. We drained about $80 billion of liquidity in the last 3 days. That's why you're starting to see a rotation in the equity market, and you're starting to see some volatility build in there. And so you have slower growth, you have less liquidity, and you have tighter credit. That's what's coming out of these Powell hearings, is that banks are tightening credit because of all the banking issues, and that starts to affect jobs. So I tend to think that we're going to have weaker growth in the second half of the year. Politicians think we may be able to do that without avoiding a recession because they're still focused on inflation. I think the recession risks here are growing.
One of the key and perhaps underappreciated risks of the past 12 months has been the fiscal impulse, the fact that you have gotten some increasing funding from the federal government at the same time that the other hand is trying to fight inflation. That's going to change in October. A lot of people are focused on the fact that people are going to have to start paying their student loans once again for the first time in 3 years, and this is going to hit disposable spending and disposable income pretty significantly. How significant is that, or is this basically just window dressing, a normalcy after so many years of fiscal stimulus?
Yeah, so first, I think that it started this week where the TGA is no longer offsetting QT. And so this was the first week we've had QT post-debt ceiling. And so the liquidity drain has started. The next step is exactly what you're referencing, Lisa, and that is the student loan payments coming back in. It's very likely in the next couple of days, the Supreme Court is going to rule down President Biden's student loan forgiveness plan, which would have forgiven balances as much as $20,000. And then you're going to have these student loan payments come in. That's about a 0.3% of GDP drag. When that consumer hits, it's meaningful. It's not something that should be viewed as insignificant. And we anticipate that the president will put forward a plan to do what's called income-driven repayments almost immediately after the Supreme Court ruling to try and at least offset some of that drag from student loans being deferred. But students with loans have not had to make payments for almost 3 years now. They've allocated that to other spending. And once those student loan payments begin to come in, it will begin to divert funds back into student loans. And you see it with stocks like Sophie, which are up dramatically since the debt ceiling deal, which forced these payments to come in, and some of the weakness in the consumer stocks.
I was reading a Morgan Stanley report about this last night, and they were talking about how this is about $200, $300 per borrower. There are about 40. There are 27 million borrowers still with these loans in forbearance. About $41,000 of debt per borrower. How much is this going to accelerate the decline in inflation, or is this something that's really peripheral that people are just sort of clinging to with the hope that it will disinflate things faster?
Yeah, I think it's going to have more of an impact on growth than it will on inflation, because the money supply contraction is really taking care of inflation. There's about a 16-month lead between money supply and CPI. We've been negative for a while, so inflation is going to come down even with these payments kicking in. What it does is it begins to slow the consumer down, which has been the engine of growth. And the key issue will now be whether jobs continue to hold up, because if jobs hold up, this is somewhat manageable. But if you have this drag on the consumer hitting while jobs are slowing, then it will matter. And the key metric here is to watch the household survey and the payroll reports, because if credit is tightening at the banks, that will show up in the small business sector, and that's what's reflected in that household survey. And that's what we're concerned about as we go into the second half of this year.
What we're concerned about, Dan Clifton, is we need to know the zeitgeist of Washington here as we roll into a heated and hot summer. Dan Clifton, stay with us. Wiley Nickel, Congressman, 13th District of North Carolina. Of course, an outlandish question to the chairman. And of course, he's an Obama guy and all that. So you just know that he's got Jerry Garcia nailed down. Wiley Nickel to Jerome Powell.
I was excited to see that from public reporting that you were at the most recent Dead and Company show. I've been to this version with John Mayer and enjoyed it, but we weren't here. How was the show? Did you like it?
Oh, it was terrific. What can I say? So it was great. I've been a Grateful Dead fan for 50 years. So.
Oh, I could see him as a young lad buying those white cassette tapes we used to buy. Alabama Getaway. Dan Clifton, this is the talk of the financial community here. Are you a dead end? Can you drive forward the effect of Dead and Company on the nation's monetary policy?
Absolutely. We think that the Fed delayed rate increases partially to help Janet Yellen be able to raise $1 trillion of T-bills that has now taken place since the debt ceiling has been raised. It's a very clumsy discussion, as you saw yesterday and you saw at the press conference last week. If you think you're going to raise 2 times, why are you doing it now? The answers somewhat are getting better from the Fed, but it's clear that if the Fed rate goes up, the reverse repo rate goes up, and if the reverse repo rate gets up, less money will come out of reverse repos to suck up that Treasury issuance. If it's not coming out of reverse repos, that means it's coming out of bank reserves.
Okay.
And that starts to put pressure on the banking sector. That, to me, is the key issue. And the read in these articles in the financial press over the last couple of days that liquidity is not being sucked up is just not correct.
Dan, we got to leave it there. Dan Clifton, thank you with Strategas, and we thank Wiley Nickel for driving forward the conversation in Washington. This is Bloomberg. Stay with us. Bloomberg surveillance correction. Sometimes I can be wrong. I thought there was a Bailey press conference. I'm told I'm wrong. I just assume they're over-communicating like everybody else.
Under-communication.
How quaint.
We need to go to communication therapy. The Fed needs to give some lessons to the
They
Bank
need to
of
find
England.
their inner self.
Exactly.
Maybe he needs to listen to the Grateful Dead. We'll have to see there. Good. Thank you, Wiley Nickel, for enlightening us with Chairman Powell's view on Dead and Company today. The pound is dead. There's a lot of huge research output right now. Jordan Rochester, I thought, Lisa, was really quite something here on sterling, up to 128 on the shock of a 0.5 percentage point lift. He says, yeah, and then they worry about slowing down, so it comes down. And what's important here is insight that Jordan Rochester of Nomura's insight that now the Bank of England is becoming like the Fed, where they're going to react tick by tick by tick to what the inflation story is.
And the inflation story is sticky, and the wage pressure is significant. And this is going to be very concerning at a time when they are fighting off some sort of downturn. So here is the tension. Have we shifted into the point where the potential for slower growth offsets the rate hikes in the currency space and starts to detract potential investors, Tom?
Also, another story we're watching in Turkey, it's not working. That's all there is to it. There's an underwhelming feeling to what Simsek and the head of the central bank have done here. They have acted off of the huge difficulties in Turkey, and we have a much weaker Turkish lira now, getting out threatening 24 lira per dollar. We'll do much more on that, because in a moment we've got the right guest for that moment. Futures at -15. Dow futures -116. The VIX still under 14, 13.92. The 2-year yield 4.74%. I guess it's a recession, but you don't know it in the home space, do you?
That's what I'm shocked by. So KB Homes came out yesterday, and they reported earnings that beat all expectations. They came out, had a very strong quarter. This coheres with what we're seeing across the board. Their shares are lower today. I really can't explain it. 2.5% lower, except that perhaps people are looking out. If they view stocks as a discounting mechanism, perhaps this brief respite is going to move into something of a higher rate and weaker housing market. I'm going to keep my eye on this. Boeing shares also lower by 3.4%. And this is the other story, the labor story that we keep talking about. There is a potential strike at its biggest supplier. Union workers voted to have a strike. To me, again, this is something we keep seeing around the world, the labor pushback that's going to keep raising prices. And I'm watching NVIDIA and Tesla. NVIDIA shares up 194% this year. Right now, taking a bit of a breather, down 1.2%, continuing that slow grind lower that we've seen over 3 straight sessions, and Tesla shares up 110% so far this year, lower by 3% as people also reassess whether it's gone too far, too fast.
Moments ago, so the guest is so timely here on Turkey, Lisa, we just got to stay with that. Moments ago, the Turkish lira, in failure of their policy, breaches through 24. That's just a shocking number to see this explosion of Turkish lira up. They raised rates, but not enough. Market speaks.
It's not making sense. And right now you can get the move right, but you won't necessarily get the market reaction right. To understand the confusion of the market response, Terry Wiseman, global interest rates and currency strategist at Macquarie, joining us here. Terry, what do you make of that? The fact that you can find out what they're going to do, but you're not going to figure out what the market response is going to be.
Look, I think it takes a long time to rebuild central bank credibility once it's been destroyed. It's not an overnight thing. Even with the replacement of the staff and the decision makers there, it's going to take a while for a central bank that has avoided raising interest rates to gain the credibility of the market. The market's going to have, they're going to be doubters. And I think when you have a situation like this, it's important for the central bank to start to reassert its credibility by doing more than the market expects, not less than the market expects. I want to make a case that in those emerging markets that have tried to tackle the inflation story head on and early, you have seen a lot of success. Obviously, Turkey's not one of them. But look at Brazil. They're on the verge of starting to cut interest rates, perhaps as early as August or September. Same with the Chileans. These countries were aggressive in hiking rates during the inflation up move, and they're going to be early in cutting rates with the inflation down move that they're seeing in these countries. Turkey's an exception here.
Okay, it's an exception. However, it's piling on the hawkish tilt that we've heard from central banks around the world today. The Bank of England, we've seen the fluctuation of the pound. Has the Bank of England lost credibility as well?
I think it did, but I think that's exactly the reason why it had to raise by 50 basis points instead of 25. Now, granted, we did not expect that they were going to raise by 50. The tone coming out of the MPC members in their parliamentary testimony a few days ago did not signal a hike of 50 basis points, but at the same time, you had an inflation print since then whereby implicitly you can make a case that the Bank of England had made a mistake. They thought that inflation was going to come in at about 8.3, 8.2%. In fact, it came in closer to 9%. I think it's because of, implicitly this 50 basis points is an admission of the mistake and a way to correct it. And I think that's why it happened.
Alan Schwartz put this team together at Bear Stearns with your leadership, Emmy Shayo and David Malpass driving the U.S. and global dialogue, John writing as well. Terry, you've seen this so many times before. How do you link, we rationalize idiosyncratic stories like Turkey or Argentina back to the central banker of the world, Jerome Powell? How do you link Powell's actions to what we're seeing unraveling here, there, and everywhere?
I think we have to be very cautious if we're going to assume that what Jay Powell is going to do is going to be overly dependent on what other central banks do. And I think even the vice versa case is pertinent as well. The situation in the U.S. is not the situation in the U.K., or for that matter, the situation in the euro area. There is not as much labor activism and labor strikes in the U.S. I know that the headlines might be prominent, but we can measure this. And the peak of labor activism in the U.S. took place last summer. It has since died down. It makes plenty of sense. We've seen more layoff announcements in the U.S. The UK and Europe are very different. We're seeing a lot of labor activism now. We're seeing a lot of concessions by the private sector, even governments, to these higher wage demands coming out of the workers. And as a result, the UK and Europe are delayed with regard to their ability to fight inflation and bring it down. If you look at some leading indicators of inflation in the U.S., they are clearly coming down, and much faster than they are in Europe. The PPIs, for example, the survey-based indexes that we're getting from the ISM services survey, the Atlanta Fed's flexible price index, they're all pointing downward for inflation in the U.S. I have a feeling, and by the way, Powell even hinted at this in his testimony yesterday, I have a feeling that in the back half of the year, you're going to finally see that so-called stickiness that we're seeing in the PCE inflation index and the CPI inflation index start to recede and come down. And by the way, I think the market understands that. And that's why the dollar has resumed being weak again, because it sees the Fed coming to an end with its rate hikes. It doesn't see that yet in Europe or the UK.
When we go into the mid-year reviews, J.P. Morgan publishing theirs this morning, and they call our disinflation path incomplete. But at Macquarie, one of your great studies has to be the greater number of lesser countries really struggling, as you just mentioned. Is the IMF going to come to the rescue here, or is the IMF lost credibility as we talk about the Bank of England challenged by credibility?
Well, if you mean the IMF coming to the rescue with regard to the debt load in the emerging markets.
To Argentina, peso 251, black market 507.
I don't think that you're going to see that happen unless these countries adopt a much more market-friendly and much more Washington consensus-based approach to the policy agenda. The IMF is not going to bail out countries that have made a succession of mistakes in their political economy and their policy agenda over the last few years. It will bail out those countries that it can impose on an agreeable basis a new plan of action with regard to fiscal responsibility and monetary policy responsibility.
I want to go back to something you were talking about, that there does seem to be a real difference between the inflation dynamic in the U.S. and the inflation dynamic in Europe. And you were talking about the labor dynamic in particular. Right now, what we're seeing are a number of central banks that paused or tried to, and now are going back and hiking rates again. This is exactly what people do not want to see. What gives you confidence that the U.S. is not going to be in the exact same position with a stickier kind of inflation, especially driven by areas like the housing market that have shown incredible resilience to higher rates?
Yeah, these are all great questions. Let me start by saying that the way that the PEC price index is computed or calculated, and the way that the CPI inflation index is computed, has inherent stickiness in it. About 40 to 50% of all the prices in that basket are imputed. So to get a really good sense of what flexible prices are doing, what prices are doing that you can actually observe in the marketplace, you have to look at narrower indexes. You have to look at only the basket of things for which we can observe prices. And when we do that, we see a lot more disinflation already. Just compare, for example, that Atlanta Fed index, the flexible basket versus the sticky basket, has seen a huge divergence in the last few months.
What is the potential shock to longer-term rates if this is somehow reversed, if somehow people are getting it wrong and inflation does remain stickier in the U.S. and follows the European story?
Yeah, so if that's going to be the case, you're going to see the back end of the yield curve go up a little bit in the U.S. At the same time, it doesn't mean that the curve will get less inverted, because we could see short-term rates go up as well. I should say, however, but to the extent that we're going to see longer-term rates go up, it's going to be because inflation break-evens go up. It's going to be because that inflation expectation goes up, not because real rates go up. But yeah, that would be effectively the result. Long-term inflation expectations goes up, inflation break-evens go up, and that drags higher the 10-year yield in the U.S.
We're linking monetary policy in here into the interests of Chairman Powell. And you mentioned as we were going on air here that you had the immense privilege of seeing Jerry Garcia. I can't believe it's been 27 years since he died. That's the first shock. But you saw the dead when the dead was the dead, and not the dead and company now. And to parlay off this, I'm going to go to what a long, strange inflation this has been. What does a pandemic disinflation look like? This is an original inflation, isn't it?
It's original only insofar as the Federal Reserve and a lot of central banks made the mistake of printing too much money at a time when they thought that the pandemic would not end, or at least they took the risk management view that there's a possibility that the pandemic doesn't end, and therefore they erred on the side of inflation, of liquidity balances in the economy. The important thing to keep in mind is that those impulses that created the inflation in 2021 and early 2022 are more or less over and done with the possible exception of wage pressures in Europe. If you look at real monetary balances in the U.S., because of inflation and because of QT, they are back to trend level. They went up about 15 to 20% above the trend, and they've come down 15 or 20% back to the trend. That's a very strong indication, a very strong suggestion that the inflationary impulse that the central banks had created is no longer in play. It's no longer manifest.
The longest dead concert, Terry was at the concert. He stood for 6 hours. The longest dead concert ever.
Stood?
6 hours.
Okay.
That's on the edge of Springsteen.
Yeah, they have epic concerts, and evidently they used to have even more epic concerts as
you get a little older.
Was.
Terry Weissman, thank you so much.
My pleasure,
a perfect
guys.
day, just perfect time to have you in here with the challenges that we see in Turkey today. They are attempting to move beyond Erdogan's monetary policy. Standard & Poor's right now down 0.3%.
When you mentioned Turkey, the lira is now the weakest on record, dropping 2.5%. So failure is correct. And I keep wanting to go back to what Terry was talking about. It is a credibility gap. And once you lose credibility for a central bank, it takes quite a bit to get it back. And an about face doesn't necessarily take do the job, just simply because it raises more questions than it does give answers.
Let us summarize right now. We're going to do that as we move through the morning here. Again, an important conversation. Maria Tadeo with the Prime Minister of Ukraine coming up in the 8 o'clock hour. But Lisa, let's just summarize up here. We started with Switzerland and Norway with what I'm going to say are fairly shock increases in interest rates. And as Lizzie said, no one really was calling for this 50 basis points from the Bank of England.
It was a surprise. It was not the consensus, which called for 25 basis points. They also talked about potentially raising rates even further in subsequent meetings. Then you had the Bank of Turkey, central bank there, raising rates too, which is completely a separate story. And yet still jumping on this train. Do we see a different story in Europe? And if so, will these be enough? Will this be enough to curtail some of the inflation and the wage dynamics while not torpedoing growth to such a degree that you scare away a bunch of investors?
I was weaned on this off of United Kingdom economics, and this is Beveridge and the rest of them a century ago. Clement Attlee as well, and Terry Wiseman, Dr. Wiseman nailed this, where it's about the labor differentials, the labor union structures and negotiations, almost the guilds of another time in Europe versus a much more free market wage discussion in America.
And we've seen it much more in the United Kingdom, akin to what we see in France, in Spain over the past couple of years. And that's one reason why people see inflation surprising to the upside in that nation.
Sterling 127.82 there, up to 128 and comes back here in the last hour. 10-year yield 3.74% in the United States. This is Bloomberg.
We see the momentum. We see a Q2, to be honest, Q2 2023 from a revenue point of view, which is higher than Q2 2022. So overall, I would say this bank is faring well. In Q3 and Q4, there is momentum in the business on the fixed side. But for us as a strategy of Deutsche Bank, it is important that we further balance out the investment bank overall.
Christian Saving, the Chief Executive Officer of his Deutsche Bank, overlooking the Deutsche Bank area from our Queen Victoria Street. They own the wall at Broadway and Winchester House, a really important discussion with a bank of Germany and a bank definitely of Guy Johnson's London. Guy Johnson joins Lisa Abramowicz and myself now to talk about Deutsche Bank and the path forward. The immovable force here, Guy Johnson, is the bank has underperformed since time began. He's righted the ship. There's no question about that. When does the street begin to give Deutsche Bank a valuation of a higher book value?
Look, there's a number of ways of looking at this, Tom. Let's start off with kind of how he looks and feels. He is much more relaxed. He is much calmer. He has a more positive view of the world than I think I've ever heard from him, Christian Saving. They've just made an acquisition in London, Numis, that caught a lot of people on the hop, a lot of people by surprise. It was in advisory, it wasn't in wealth. But he's talking about further acquisitions. He definitely feels that he can now put his head above the parapet and take a look at what's going on. But I take you back to the Credit Suisse story. Where was the next place that everybody looked when the Credit Suisse story started to develop and gain momentum? It was at Deutsche Bank. And we had that day when Deutsche's CDS went crazy and shot higher. Now, he certainly feels a sense of frustration that they are still in that place. But he says, look at what happened in that situation. We got through it. We are a profitable bank. So I think he is pleased with where they are. Is there progress to be made? Absolutely. But they are not the bank they once were. It is a very different bank. It is a more balanced bank. And I think that is the message that Christian Saving is trying to deliver.
I look, Guy, at the message to deliver, and it has to come with expansion. And what we saw from Numis. Our American audience doesn't know Numis. What is Numis and what does it mean?
So this is what they were buying with Numis, which is a big corporate bank in London, big corporate house in London. They're buying a a huge number of corporate relationships. And this is where Zeving wants to take the bank. He talks about the house bank. This has been his strategy from the get-go. The trading side of the business, he wants to downgrade that. He wants to upgrade and balance out these two sides on the corporate side. That is the bank that he wants to become. So Numis fits with that strategy in so many ways. But the trading side, Tom, has carried this business through the last few years. That FIC business has delivered significant profits, which is why when James Mamolka, the CFO, got up the other day and talks about the fact that he sees 50 to 20% downside in Q2, everybody sat up and paid attention because they're really good on the FIC side. And the fact that they were seeing that, everybody was wondering whether or not they could extrapolate that into the full year. He says he doesn't think so.
Guy, does he think that higher rates in the Euro region are good for European banks?
They have been. At some point, he said the net interest income tailwind that they have received from higher rates will start to fade, and that's when maybe you do get the more balanced approach. So yes, it has helped. Negative rates, Lisa, were terrible for Eurozone banks. I think everybody in the banking sector is glad that that situation has gone away. However, look at what's happened today. Today has been a hugely volatile macro day. You guys have been talking about what's happening with the Bank of England. We saw the Norge Bank earlier, the SNB, delivering a hawkish 25. The expectation that Q2 was going to be a little bit weaker after the debt ceiling, all that sort of stuff. I think what they're saying is that they think the volatility that we're seeing in macro is going to continue and it's going to come back. So the second half of the year is likely to be a better environment for that FIC business to operate in, and maybe Q2 was a blip.
You know, we don't talk about this often with Deutsche Bank, but back in 2019, they cut 18,000 jobs and said that they were exiting global equities. They've made a big retrenchment, and now they're looking at trading as carrying the day and continuing to produce profits. How do you square that? What does that mean? What's the message for other banks in terms of what kind of footprint, the size, the nature they have to make bank in trading?
You've got to be substantial. Equities has been parked. FIC is where this bank has been incredibly strong, and they've been very good at it, and they've delivered significant profits from it, and that has helped them through this period. That's not the model that Zeving is looking at. That's not where he wants this bank to be. He is looking at a more capital-light model. He is looking at a less volatile model. And back to Tom's point just a few moments ago about what rating is Deutsche ultimately going to be on, investment banking, trading is a lower rated business because of the volatility that comes with it. He wants to take the bank away from it and therefore, by extension, maybe deliver for Deutsche and its shareholders a higher rating. And I think that's the direction of travel here that Zeving wants to take this bank in.
Guy, I want to give you a victory lap on a really interesting Paris Air Show, certainly the most interesting for me way since the pandemic. I just thought it was fascinating. The size, the number of orders. You spoke with the chief executive officer of Toulouse Airbus. Airbus seems to be real competition for Boeing. Who's winning that battle right now? Who has a technological lead, Airbus or Boeing?
When people compare Boeing and Airbus, in some ways they're not comparing apples with apples, Tom. Boeing has been very strong in wide bodies and continues to be very strong in wide bodies. Airbus has, and it was John Leahy who made this decision when he was Chief Commercial Officer, the success of the A320 family has been enormous for Airbus. And as we saw markets opening up, that narrow body market has become huge. And that's where Boeing has struggled with the 737. But the Boeing still has strength in wide bodies. And I think that's where it gets really interesting. Boeing has had a really tough time. Look at the news out of Spirit. Spirit is going on strike. The staff over at Spirit have rejected an offer that unions backed. Boeing is having a really tough time with a number of different issues. They're both facing different challenges. I would argue in the narrow bodies, Airbus has been the clear winner. But Tom, if you try and pull these conversations together, my takeaway from the Paris Air Show was that demand is still absolutely sensational at the moment.
Right.
You then plug that back into the central bank story, the Bank of England today. It is an economy that it sees as being stronger. The consumer is still stronger. Jay Powell has talked about that. We've seen it in the data. And then you plug it in, that macro volatility, into Deutsche. These are how these stories connect. But the takeaway from all of them, I think, is that the economy is actually in relatively good shape, and that's something that central banks still have to lean in on.
Guy Johnson, thank you so much. In London at Queen Victoria Street. Lisa, I look at this and I take what Guy says there, or frankly, your analysis of it as well, and I bring it over to the Bloomberg Launchpad, equities, bonds, currencies, commodities, and there's one number, it's the elephant in the room, and that is the recession indicator. 2's10 spread is at 100 basis points right now. The two-year yield, folks, is 1 full percentage point, 1.00 bigger than the 10-year yield. That's undoable in the Tom Keene textbook.
It's climbing back to the levels that were the most inverted going back to 1981. Typically, the telltale sign of recession at some point, maybe in 18 months, but we've been seeing this for a while. What I'm also watching is real yields, basically inflation-adjusted expectations of the yield that you're going to get, 2.7% on 2-year. That is the most going back, I believe, to before the great financial crisis. So we're looking right now, the highest going back to February of 2009. So at a certain point, are we looking at restraint in the financial markets that potentially is more significant and accelerating?
It's a huge point of tension here. And again, I'm going to show oil threatened here. I don't know where oil fits into this discussion, but nevertheless, the fact is off Switzerland, Norway, and the United Kingdom on recession worries, I guess, 71.10 down $1.43 on West Texas.
The biggest mystery as we head into the 10 a.m. second day of Chair Powell's testimony in front of the Senate today.
Will it change today?
Well, I mean, we heard a pretty hawkish tone yesterday, and yet this is sort of the offset. Atlanta Fed President Raphael Bostic coming out with comments that were much more dovish. He really was the one who wanted to stay on hold. He said, "We have good reasons to expect our policy tightening will be increasingly effective in coming months, which would accelerate progress to that end," meaning reducing inflation. This idea that the longer that you extend the x-axis of 5% or 5.5% rates, the more pain you inflict on an economy. That is the mystery underpinning the U.S. picture and the distinction with Europe.
Please stay with us. It is a fascinating day out there. Turkish lira through 24.20. Sterling at 128, then pulls back. We'll have comments from Governor Bailey. U.S. futures at -12. From New York, this is Bloomberg Surveillance.
We've got the bond market screaming recession. On the other hand, the equity market saying the Fed's not going to be able to do what they want to do.
I think the Fed is going to be torn between stability, their goals of trying to raise short rates, and yet providing liquidity.
How much tightening do they need to put into the economy? How much do they have to dampen down on demand in order to get inflation under control?
We're really looking at an economic malaise more or less than a recession on the horizon.
We're heading into an environment where 2 to 3% inflation, in our view, will become the norm.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Everyone's hawkish today. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. John Ferro is on vacation. He will be back after a couple of weeks, and it will be a good and wonderful thing. But I start on this idea that we've heard from central banks. I'm just going to keep talking over that. They keep hearing from central banks, whether it's the Swiss National Bank, whether it's the Norwegian Bank, or whether just now the Bank of England, or even the Turkish Central Bank. Everyone's taking a hawkish tone. What now does Jay Powell?
It's been a real sea change. We had a day, Tuesday was pretty quiet. Wednesday was quiet. This is not quiet. And I'm sorry, I'm going to sum it up, Lisa, just simply here. It's the sum of all these parts. In hindsight, you say, well, of course, the United Kingdom raised 50 basis points. Of course, should Jerome Powell have raised rates at the last meeting.
And what we're hearing is this tone of exceptionalism in the U.S., not only tech exceptionalism, but also inflation exceptionalism, this idea that it's a different dynamic in the U.S. versus Europe. So how exceptional is the U.S.'s inflation story, or is it the same surprising to the upside that we've seen over in Europe?
I mean, we'll have to see. I mean, there is a difference here, and I think we've covered it well here through the morning, the distinction here between Europe. But what we're really talking about is a potential mindset, and I'm going to give it a broad collar, 5.50%, up to where Adam Posen is making headlines in England this morning, 6.5%. Has anybody even gone above that? We're just banding up the yield structure as we go through June.
And the confusion is just why there has been such resilience, right? Why have we not seen a greater degree of pain more quickly? And that's really one of the big mysteries as we see the housing market rebound, and we're going to get some more housing data at 10 a.m. To me, that is one of the key issues that we keep facing off with, Tom.
I want to bring to you an important story this morning. This is just breaking, and this is Bloomberg News reporting. Our Akshat Rathi, Ari Nader, and Keith Naughton in Detroit. If you are of a certain vintage, as I am, this is stunning. There's no other way to put it. The Ford Motor Company, we spoke to their chief financial officer in recent days, has garnered a $9.2 billion loan from the U.S. Energy Department. The scope and scale of this on this new Manufacturing America. This is Gary Silberg of KPMG. Not since the advent of the auto industry 100 years ago have we seen an investment like this. Lisa, I'm not prepared for this. It's such a sea change.
The goal is for this money to finance the construction of 3 battery factories in the United States. And this goes with their $400 billion project of the U.S. to try to build out some of the tech prowess and the new energy situation versus other nations. There are a lot of questions here. There's the geopolitics of it all. And then there's also the growth of it all, the feasibility as well, because there are a lot of loopholes and things attached to it. But this goes to the whole exceptionalism question. How unique is the U.S. at a time when you have NVIDIA, when you have Tesla, and you have these infusions of cash from the federal government?
We have the perfect guy to talk to about this morning. We're 2 for 2 today. We had Terry Weissman with Turkey blowing up, and Daryl Kronk joining us now from Wells Fargo. And you're right, Lisa, it's American exceptionalism, and that is paramount to what's also undersaid here, which is China owns the battery market.
Right, and that's...
And Republicans and Democrats want to take that market with us. We're making this up as we go. We're ripping up the script. Lisa, bring in Daryl Kronk of Wells Fargo on American exceptionalism.
And we're talking American exceptionalism as equities do have a softer tone for a 4th straight day. But Daryl Kronk is joining us with this feeling that perhaps the U.S. is different. He's president of the Wells Fargo Investment Institute and chief investment officer of Wealth and Investment Management. Do you buy into this, Daryl, that there is a U.S. exceptionalism that keeps your eye and your money focused on the United States?
I don't know that I'd say exceptionalism, but there's absolutely a U.S. bias for investors as they think about it. I mean, the Ford News this morning is all about batteries, right? And that is the constraining factor for the next step higher for the EV market, right? The electric vehicle market. The reality is, to your point earlier, China has owned the chip market and they've owned the battery market, right? And so to dislodge that or to move it to other parts of the world, both from a supply chain standpoint, but just a diversification standpoint, requires a huge amount of investment. And you're seeing that investment today. And those are the companies that are propelling us forward. I was just looking as we were coming in this morning, you know, what most people probably don't understand is if you take the S&P 500 now and you take the NASDAQ 100, they're almost the same index. The top 8 names are identically the same if you go down to them. Literally the same. The only difference is the weighting, right? And they're all the tech names that you all know about, right? So we've conflated this into a world of technology, right? That's what has to win. That's what has to excel for the U.S. exceptionalism argument to continue to work.
To me, so much of this, this is such an important conversation. Again, folks, if you're just joining, Bloomberg reports that Ford Motor Company, with a loan 3 times larger than GM last year on the battery battle, the lithium battle with China, is well. There's a Daryl Kronk difference here. You were weaned off the fields of Ames, Iowa. Okay, you weren't in 3 zip codes in New York. Now he's at a fancy place. And how come he's at Hudson Yards and we're not? What's that about?
You can come over anytime you want.
We'll do that. We'll do a show from there with a. You seen a copper thing they've got there?
Yes.
Looks like a can opener.
Yes.
Kind of thing.
A vessel.
This is serious stuff. We're not prepared for manufacturing America. It's not little Switzerland. There's something going on here. Are we going to have manufacturing America?
I think you will over time. And you're already seeing, you know, the pandemic really accelerated that on the need to kind of, back up and reshore and get your supply chain more secure, if you will. I mean, what's interesting is, we're having a great debate even within our strategy committee about, the recovery, the not recovery, and what's happening here. And if you look at industrials are quietly doing very, very well. Why? Well, some of that is the reshoring and the reindustrialization of America. Some of it is the Infrastructure Act. I mean, I travel the country all over the place in the U.S., and I can't go to an airport without it being fully under construction. Any airport, right? Doesn't matter which one I go in and out of, right?
So true.
So where's all that money coming from? Well, it's coming from infrastructure acts and places that capital infusion has happened to try to resurge the economy.
So here's the tension. On one hand, you do have these investments. You do have this promise of new technologies that have caused people to invest more into technology stocks in particular, but stocks more broadly. And on the other hand, you have this fueling inflation and the stickiness that we keep seeing. Which is going to win out? Do you think that we can see a stickiness of inflation and still see almost a haven in stocks because of some of these infusions?
In our opinion, no, right? And I think the key word there, Lisa, that you hit on is stickiness. Because if you track inflation over time, when we've had past inflation bouts, it rises quickly, falls quickly, then trends sideways, and then rises again, right? And I think we're starting to see some of the early signs of that. Look at the housing starts and the permits yesterday, right? The housing data we saw, right? That's 25% of core CPI. We already know core CPI is at 5.3% annualized, way over where the Fed wants to be, right? If you continue to have labor market strength, if you want to call it that, services strength, right? All that feeds into the core. That's way too high for the Fed, right? Even though the headline number is going to come down, there's no doubt about it, right? We'll probably see in June and July the headline CPI with maybe a 2 in front of it, right? It's entirely possible.
Would you feel comfortable going into longer term bonds at a time when some people are asking, has the Fed lost credibility? We've been talking this morning about central bank credibility.
Yeah.
Inflation is sticky in certain pockets. Core CPI still very high relative to the goal. And yet we saw this pause and pretty confusing rhetoric. Is that a concern?
So we went favorable long duration or long-term bonds in October of last year when the 10-year was at 4.25. That was a great trade. It ran all the way down to basically 3.25. We're back to 3.75 today. Anywhere above kind of 3.80, 3.90, 4%, we think is a good value on the long side of the equation. The interesting thing is, even if you give the Fed credence and credibility for 2% inflation, let's just give them that number, right? The reality is if you give them 2% inflation, 3.75 on the 10-year is still too low by any historical measure of how you would gauge the 10-year relative to a normal inflation regime. Go back and track it in history. Right. It should be higher than that, right? So why is it not? Some of it is concern about the inverted yield curve and the flight to quality that's happened. But we were inverted by 100 basis points, you referenced earlier, Tom, by maybe a day and a half in March, right, quickly, and then we lost it, right? We went all the way down to 40 basis points. Now we're right back there again. The bond market is just screaming that tougher times lie ahead.
Daryl Crunk, I want you to talk in this huge announcement by Ford of $9 billion to take on the Chinese and batteries. The fact is the Wells Fargo heritage is a rutted trail across this nation. That's the imagery.
Right.
Have you seen the Stagecoach? I've never been in the Stagecoach.
There's one at Hudson Yards.
There's one at Hudson Yards. Should we go? We do the remote.
Yes.
We can do the remote from inside the Stagecoach. You can sit up on top of the horses.
Thank you.
We'll bring the horses
Anything else
in as well.
For?
The heritage and branding of Wells Fargo is about this nation from sea to shining sea. I want you to talk to the people scared stiff in cash with a 3, a 5, or dare I say a 10-year view. How should they perceive American investment?
Well, I think American investment is very strong. I wouldn't be wildly overinvested in cash here today. We do think there's good opportunities. I will tell you, we're not seeing those opportunities as robustly in the equity markets today. We see them more robustly in the fixed income markets. We actually think, a little bit to your point, that you're in a Super Bowl market for commodities, a long-term bull for commodities on just a global undersupply across the board.
Can you be long energy, including big oil in America?
We're most favorable right now on energy as a place to be. It's down 10% today. The dispersion between the best and worst performing sectors, tech up 40, energy down 10, right, is 50% as we cross mid-year right now. That's a good value right now. Energy, I'm getting I'm getting 8 to 9 multiples with a 3.5% dividend. I'll take that valuation all day long.
We have to run. Daryl Cronk, well-timed with Wells Fargo. The Standard & Poor's, a percentage move, 0.3%.
The idea of some of these loans and the fiscal spending, I think, dovetails pretty well into what we've been talking about all morning. Is there a conflict right now, Tom, between the fiscal impulse and the monetary impulse? Can you get growth and reduce inflation at the same time? Can there be some sort of soft landing, or does there have to be a trade-off at some point, even if it hasn't come yet?
I gave a speech last night, and the first thing I opened with was a disaggregation of America, like we talked to Sri and with Aberdeen earlier this morning about the disaggregation in the United Kingdom. It's about the haves and the have-nots. You see this Ford announcement, and I go back to there's got to be winners within that. There's got to be winners within the fancy people of the Bloomberg surveillance world and others across this nation. But there's got to be also a lot of technological losers as well. And that's the political battle.
Well, giveth and taketh, right? Because on one hand, you've got the giveth of the loan, and we don't know exactly what the parameters are attached to it. Again, just
come on, the parameters are to beat the Chinese. The Chinese have X% of the lithium battery market, and we're scared stiff.
But a lot of people talked about some of the strings attached to some of these loans and some of these government programs that do make it a little bit more complicated. On the flip side, the student loan issue, I do think is important, and I don't think that we can drop it. The fact that suddenly people are going to have to start paying again for the first time in 3 years, and that's going to start in October, and that could mean, $300 of disposable income that's going out the window after all these other loans have been incurred by the consumers. I think it's significant.
What do you say to all the people that paid their loans along the way?
Congratulations, but there still are $1 trillion of people who have it, more than that.
The size of it is, the scope and scale is amazing. My head's spinning over what's going on today. Turkish lira at 24.23, sterling 127.70. Michael Gapin with us in a bit. This is Bloomberg.
We're very far from our inflation target of 2%. We are strongly committed to getting inflation back down to 2% over time. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. Earlier in the process, speed was very important. It's not very important now. Given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
Jerome Powell on script there. Michael McKee said he really stayed right close to the script there. Mike McKee scheduled to join surveillance here at some point. What an odd day. Thank you for joining in. We need to do a data check with some of the storylines behind the data check to encapsulate a Thursday claims. This is the first time we've mentioned claims in 12 minutes. That shows you the topsy-turvy day it's been. I'm going to go through equities, and Lisa, pick it up with your story du jour. Futures negative 11, Dow futures negative 88, the VIX 13.81. I'm going to call it a fractional weight to the tape after 2 days of struggle. Lisa, what do you see?
Well, just a grind higher in the front end across the world, frankly. You can see that in the United Kingdom with two-year yields near the highest levels going back to 2008. And you can see that in the U.S., where you have two-year yields grinding to the highest levels versus 10-year yields going back decades, at least getting close to that level. What I'm also watching, though, is the pound. And to me, this tells a very significant story, the pound versus the dollar. We have reclaimed a bit of strength, 127.82. But if we don't see more strength, what does that say about the credibility of the Bank of England after delivering a bigger than expected rate hike of 50 basis points?
As Mark Chandler said, for longer. And that it doesn't matter really the level. Every country, Norway has a different story than Switzerland and the United Kingdom and others. But it's just simply put, we're readdressing for longer today across so much of what we look at in the fixed income space. We should mention Turkey with some announcements on what some would say is proper policy, but maybe not enough. Even with those announcements by Mr. Semsek and the central bank, Turkish lira breaches 24, which is a huge deal. 25 is unimaginable. Lira 24.23. It seems odd and out there, but maybe it's a little bit of the emerging market angst off of interest rates higher for longer. I'm exhausted by this. We need a brief. Ira Jersey to the rescue, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, how does your world change if all of a sudden rates are higher for longer?
Well, we've been calling for the not necessarily the higher, but certainly the longer for most of this year. And that was one of the biggest mispricings in the market, was the idea that we were going to have significant rate cuts this year because of inflation coming down. So I think that now we've completely priced it out of the market. You saw this morning from the Bank of England, a 50 basis point hike that wasn't fully priced into the market. So you're seeing a lot of that bear flattening of the yield curve in both Europe and the UK. And there's the risk that can get even more acute there. I think the U.S. is a bit in front of this. Like the U.S. is a little bit closer to the end. Like even if you look at the dots, you're talking about one or two more 25 basis point hikes, whereas in England you can wind up still with another potentially 50 to 100 basis points of hikes.
Ira, you and among others, Priya Misra, absolutely nailed the further inversion scope. It was 40 basis points. 60 was unthinkable, 80 was an oddity said by strange people like you, and you had the courage, I remember, to go out to 100 basis points. What does 100 basis point inversion mean to our mortgage industry, to our banking industry, to something as basic as net interest margin?
Yeah. Well, for mortgages, it's not that big of a deal, really, because you still have 10-year yields, 7-year yields, under 4%. So really, that's what is the spread on mortgages, and that's being affected by different Fed policy. That's being affected quite a lot by Fed runoff. But for the banking sector, I think it is pretty. There's kind of a haves and have-nots. So the large financial institutions that have a lot of bank reserves, they're getting paid interest on those reserves. So one of the things that you've seen over the last year and a half is actually net interest margins for some of the larger institutions actually go up, because of the fact that they could take advantage of the Federal Reserve paying interest on these reserves while they're not paying on deposits. So but one of the effects of that is now people have been, particularly this year, and this is one of the issues that became more acute a couple of months ago, is people have been reducing their low interest bearing deposits and going into money market mutual funds. And so that's created kind of a funding issue in some places, and that's continuing. You still see some, not so much, the deposit outflows have slowed, but you still see deposit outflows and money still flowing into money market mutual funds regularly. And that means that you have these supply-demand dynamics in fixed income that really favor the short end right here. And your previous guest mentioned 5% money market yields. That's reasonably attractive, right? If you have a 5% yield, the question is, how long will we stay there? And it seems like we're going to stay at that 5-ish% level for money funds, maybe for the rest of the year and into 2024. So that's not necessarily a terrible place to kind of hide a little bit if you think other markets are going to be volatile.
Well, to that point, we're about 98 minutes away from day 2 of Chair Powell's testimony. There's a real question here about what hawkish means, given that he is sort of doubling down on the message that most members believe that rates should be higher. You said that now the market is perhaps mispricing less the idea of higher for longer. Is it still mispricing that risk? So we could see 5% or 5.5% or even 5.75% Fed funds rates for a considerable amount of time.
So, well, let's say first we have to get to that 5.5%, right? So we do have, another hike is fully priced, not 2 though, which is what the dot plot suggested. So the risk is at some point, maybe if the Fed does hike in July, that we price in potentially another hike. The market right now, the way that if you look at options pricing and what options on short-term interest rates are suggesting to us is that we're going to have interest rates that are at this level into 2024, and then will slowly go down. And then by the end of 2025, interest rates will be around 3%. That's where the Fed funds rate. I think that ultimately we're going to have a much harder landing than what the market's currently priced for. But it's not going to be obvious that we're in that situation probably for another year, at least in our view.
My head's spinning, Ira. I mean, I got to take some Tang. Hold on. Tang Zero to calm the mind. Ira, are you saying we're going to have the mother of all recessions because of this interest rate mess we're in?
Well, I don't think it's going to be as bad necessarily as the last 2 recessions, but I do think that we can have a significant slowdown in credit activity. We wind up with an environment where where unemployment is, starts to rise, but wages don't necessarily go down. So it winds up looking much different than some of the recessions that we've had over the last 40 years. But when you have I don't want to call it a stagflationary recession, but when you have a recession where inflation is still a bit high and you have a central bank that's reluctant to cut interest rates to fight inflation, you really wind up needing to see, and probably they don't cut until you have a much weaker job market, and it's not obvious that that's going to occur probably until it's almost too late that it will occur.
Ira, thank you so much. Ira Jersey leading all of our fixed income coverage at Bloomberg Intelligence. He publishes. Look for that on the terminal. Lisa, is your head spinning like my head's spinning?
Well, these are the different nodes of the debate, and this comes at a time when a lot of people are trying to understand what it means if you don't have a central bank response of cutting rates to weakness in the economy. That really hasn't been tested yet. People are just simply gaming out weakness. And that, I think, is really the tension, especially as we see some of these political back and forths in Washington, D.C.
I look at the partition of we were ultra-accommodative, then we were some form of on the edge of restrictive, and I have no clue if we're restrictive now or not. But again, the time duration of this, maybe we're a restrictive point, is fine. Its impact on different parts of society, to me, is the front and center debate.
I take that point just to bring you this and to sort of build on that point. Marko Kolanovic over at JP Morgan coming out with his latest saying, without a significant rate cut, it's hard to see how stocks are going to significantly rally. This is the tension right now underpinning some of the debates.
The future's 43.98. Let's round it up to 4,400 as well. In minutes, we will have a conversation with the Prime Minister of Ukraine, our Maria Tadeo, in London with Denis Shimal. This is Bloomberg Surveillance. Good morning. Bloomberg Surveillance. What kind of day it's been? I didn't mention claims until I think 14 minutes ago. That's how interesting the news flow has been. Futures at -11 here. The economic data sort of staggering to the end of the week, but claims, weekly claims, 4-week moving average of claims have been of interest recently. Here to report on claims, our chief claims correspondent, Michael McKee, at Fed National Activity Index as well.
Yeah, the Fed National Activity Index slips a little bit, suggesting a bit of a slowdown in May. I wish I could claim to have the number of claims, but so far it is a little bit delayed coming down the pike. We'll have it for you as soon as we can.
Do you have a number in your head which validates the economic slowdown theory, the cracking of our labor market?
I think, well, when you look at the numbers, you have to get up close to 300,000 to match where we were in previous recessions, leave the pandemic behind. Okay, here we go. 264,000, which is a small increase over the 262,000 that had been reported a week ago, still waiting for the revisions. The market had expected 259,000, so not a big change. And as I said, it's still way below where it was last 3 times we went into recessions, excluding the pandemic. 4-week moving average is, or actually not 4-week, the continuing claims number, 1,759,000. That's a drop. Oh, and last week's number, revision, 264. So no change at all when the numbers are revised, which is what happened last week. In other words, the claims market is telling us the labor market is still tight, backing up what Jay Powell said yesterday to members of the House.
I look, Mike, at the data coming out, and I guess we've got to prepare for next week as well. Jerome Powell it's a different set of questions today at the Senate, isn't it? What's the question we may want to lean forward and listen for today? Don't tell me it's a Deaden company.
I'm not sure anybody in the Senate is as big a deadhead as some members of the House, but we'll find out. Now, the interesting thing about yesterday, Tom, was that it was much less political than a House hearing usually is. Clearly, the banking lobby had put a lot of questions to the members of the House, because a lot of questions were on bank regulation, and probably more than there were on monetary policy. But there weren't many of the don't you think Joe Biden is the worst person in the world kind of questions from the Republicans, and don't you think Republicans are terrible for the economy from Democrats. You usually get that at the House, and you didn't. So I'm not sure we'll see a whole big change today. Probably any news that was made yesterday, and the message was, we're not done. We're going to raise rates, and the market took it as no change from what we went into this with.
Before we let you go, I am curious to put this all together. We've heard throughout today there is a hawkish tilt in a lot of the central banks, certainly over in Europe. People saying the U.S. is different, that inflation isn't as sticky as it is in Europe, that it's not going to surprise to the upside, that you are seeing a deterioration, and that it can be a soft landing. Is the data backing that up? Are we seeing some of the unemployment ticking higher with a softness and an ease that can lower inflation without having to materially cause some significant recession?
You're seeing 50-50. I mean, you saw the tremendous jump in housing starts this week, and yet we've seen consumer confidence a little bit stronger, not a whole lot. Retail sales are hanging in there, but they have slowed in general. So the overall economy in the U.S. is kind of in a middle spot. And I was telling somebody yesterday, you could get Neil Dutta in here, and you could get anyone, a number of doves, and you could have a nice food fight over whether the economy is going to do that. The thing that you're right about, Lisa, though, is that central banks are increasingly, they're going the same direction, but for divergent reasons. The U.S. has still got an inflation problem, but talking about slowing its rate process. England has an inflation problem that's really bad, and so they're talking about speeding it up. Norway today raised by 50 basis points because they're worried about their currency. The Swiss say they're almost done. The Chinese are cutting rates. So this is going to be an interesting time and divergence around the world, and we'll see where growth goes because of that.
Michael McKee, thank you so much for running all of our economic coverage this morning. We turn to Michael Gapin, head of economics, Bank of America Securities. Michael, my head's spinning. There's so many trends going on here, and as Mike perfectly encapsulated, the ambiguities of the moment are immense. What is the thing at the margin you're studying subject to change about American economics? What's the part of the story that interests you?
I think there's two parts. One is what Lisa mentioned. How quickly can inflation come down, even in an environment where the labor market is extremely tight, per Powell's words? So can we get further diminishment in goods prices, used car prices, shelter inflation, same conversation we've been talking about for some time. But I think the mirror side of that coin, which Powell emphasized yesterday and we and others have been picking up on more, what is the big miss really this year has not come on inflation, it's come in the labor market, where the labor force has rebounded extremely rapidly this year. Last year, the shortfall in the labor force from kind of pre-COVID projections was as high as 2 million and not falling. By our estimate, it's down to about 400,000 now. That means the probability of a softer landing or mild recession is higher, and the Fed doesn't have to lean on the labor market as much, perhaps, to bring inflation down. So it's that labor force rebound, from my perspective, that puts the Fed in a very different spot today than it was thinking it was in maybe 6 to 9 months ago.
Michael, how does Fed Chair Jay Powell draw this distinction at a time when his compatriots over across the Atlantic are moving in the opposite direction and are facing resurgent inflation, exactly what they didn't want to see in a Burns-like kind of situation?
I think this is where one time you fall back on the U.S. is a large, relatively closed economy. We're less affected by global trends than is the case elsewhere. And we'll make the decisions on our policy outlook based on where the domestic economy is. The upside risk on inflation in the U.S. will come out of U.S. labor markets and whether there's persistent tightness in the labor market that keeps services inflation elevated. So I think you just kind of fall back on the historical tendencies of the U.S. to be much more domestically focused, services driven and therefore we're going to set our policy based on that evolution.
The other aspect of the conversation is the fiscal side versus the monetary policy side, and people are talking a lot about the fiscal impulse of having to repay student loans again starting in October. We've been debating this for a couple of days and trying to figure out whether this is an overplayed risk or an underplayed risk. Do you think that the reinstatement of having to pay back your student debt after 3 years of a moratorium is going to have a material impact on both growth and inflation in the United States later this year?
I think we would come down on the side that from a macro perspective, it's unlikely to have a material effect. It should probably dent the strength of spending in, say, September or October, but the magnitude of interest payments is maybe about 0.2% of personal income. If you fold in principal payments, it's closer to maybe 0.5%. So from the macro perspective, we doubt it has a material impact. Although certainly at the individual level, it may affect behavior quite a lot. It just doesn't, we don't think it adds up to something macro systemic, if you will. So it's probably more about credit markets and the behavior of those as opposed to the macroeconomy more broadly.
What does Bank of America see, Michael Gapin, in your immense ability to tap knowledge on the American consumer? And I want to get granular here. Through the month of June, is there any indication of a slowdown of the American consumer?
Yeah, there is, Tom. There is, and our B of A card data would suggest that consumer spending continues to slow, but at a moderate pace. And when we dig into those details, we do find that some of the revenge spending categories are starting to show softness. So airlines and lodging, which were really strong last year, those things have started to moderate. But spending on entertainment and recreation, that is still strong. It maps into what we're seeing in the labor market, where 2/3 of your gains in private sector employment are still coming from areas like leisure and hospitality and education and health. So there's still some catch-up spending, leading probably to follow through in hiring. But on the margin, it does suggest that spending is moderating. It's about flat on a year-on-year basis, and in some categories moving slightly negative.
Michael, I have to say I'm hearing all of the noise behind you, and I'm thinking to myself, a lot of people are back in the office, and how different this is than what we have heard for so many years. Is that your experience, that this has actually been this sort of sea change or reversion, and the whole work from home trend has kind of died out?
I think that's very industry specific and probably job requirement specific, where I'm in at least 4 days a week. Sales and trading here is in 5 days a week. So certain roles are definitely back in the office. I see it on my regular commute as well. So, and certainly Monday, Tuesday, and Wednesday, Tuesday, Wednesday, and Thursday are your big peak days. So yeah, there's kind of 3 out of the 5 days it's feeling, quote, normal. And then it kind of tapers off as the week goes on.
Friday at Bank of America, Moynihan's out at the summer place. Gapin's in with shorts and flip-flops.
Oh, that's a celebration of the fifth day.
A scary thought. Michael Gapin, thank you so much with Bank of America as well. I was downtown last night, not downtown. Let me correct that. I was midtown last night. Getting below 59th Street is downtown. And I was shocked how busy and buoyant a Wednesday is in New York City. We just got to get the Wednesday to the Friday. And that's the great challenge for a lot of business people.
Well, if you go past 59th Street and then a little further still, on the weekends it's quite crowded as well. I will just say that you are seeing a real resurgence of the city center. And this has been one of the complaints about why people aren't coming back to the office from some of the executives, saying you can go out to eat, and they are. A lot of people coming back.
Yeah, but I just wonder, how do we get from a buoyant Wednesday, as you mentioned correctly, the noise, the fervor there at Bank of America on a Thursday. But what's Friday? What's Friday look like? You and I and John are the only ones that are here, with our staff. I mean, Amy takes off about every 4 out of 5 Fridays. I mean, that's what she's doing.
There's a real reset. I was actually looking at some research over the past couple of days about how the listings for remote work have completely fallen off a cliff, that basically the whole experiment isn't necessarily being fulfilled in terms of what employees want to see.
Yeah, it's going to be interesting to see. Got an improvement in the tape here, still -7 on Standard & Poor's 500, but nevertheless a bit of a lift to the tape. The cross currents, folks, are fascinating, starting with 110 euro. Sterling with a 128 print over the shock of that 50 basis point move. Thank you to Lizzie Burden for her coverage from London. The Standard & Poor's 500 now down 0.2%.
Coming up on the Open, Alessio DeLongis of Invesco will be joining me. I am filling in for John Ferro yet again, and Megan Robson of BNP Paribas, and Mark Heffley of UBS, which will be fantastic to have him on. I'm really curious to understand these upside surprises to the rate hikes around the world, the Bank of England leading the charge, as well as the Norwegian Central Bank, what this indicates for the nature of inflation going forward. Have we fully appreciated the stickiness at a time when you are seeing an Arthur Burnsian kind of reversal from perhaps we don't need to do that more to we need to do a lot more?
I think it's going to be interesting to see. I just don't have any strong opinion. I wonder if we're going to see in the next 24 hours, folks, some research navel gazing and saying, you know what, Jerome Powell should have raised rates to keep up with the others. I really wonder if that's going to be part of what we see.
Well, he actually had some details on that. He basically said that they are probably going to raise rates further. He did double down on that hawkishness. What he said was it matters less the pace, that speed matters less after how quickly they've raised rates. Whether people buy it or not remains to be seen. Right now in markets, you are seeing a credibility from the Fed that you're not seeing with the Turkish central bank, certainly, because people are expecting them to get inflation under control, as you can see from the longer end of the yield curve.
Francine emails in. She says, well, John, he's in Ischia. I think that's how you pronounce it. He was in Capri, and now he's in, I think I'm pronouncing this right, Ischia.
Is that what you were looking up while I was talking?
The rabbits, John's having the rabbit stew there at La Portobello, it's called. It's island to island. On assignment, Jonathan Ferro. Futures at -9, Dow futures at -72, the 10-year yield 3.74%. Stay with us. This is Bloomberg.
It's clear that in the EU we should continue to build on our strengths of being open economy, of being a trading superpower, but at the same time there are certain economic security concerns which we need to address in a more conflictual global geopolitical environment.
One of the most interesting voices on continental Europe, Valdis Dombrovskis, is a former prime minister. He is executive VP for trade for the European Commission, I should say. He's really been helpful with Bloomberg surveillance over the years. We love at our global audience, and particularly our audience in continental Europe, who thinks nothing of flying down to Ischia. I said Ischia because I didn't know which island Ferro was on, Mike McKee. And it's Ischia. Thank you to Oppenheimer and Company and BNP Paribas Paris for correcting my fractured Italian. This happens.
We can't send you.
He's on assignment. I mean, I can't go. But he does it better than we do. You and I don't do this.
Well, that's because he follows Italian football.
Yeah. So, he's in Capri one day and Ischia the next day. Thank you so much. Frank, thank you for emailing us as well. Nobody sends me any emails about Powell policy. It's about where Ferro is, which island he's on as well. We're waiting right now for an interview with our Maria Tadeo with the Prime Minister of Ukraine. We'll bring that to you as we can. But quickly here, Michael McKee with us. Is the war in Ukraine affecting the American economy?
It is at the margins. It had a big effect in the beginning because, of course, energy prices went up. And we also saw agricultural prices go up because of the agricultural exports from Ukraine that weren't getting out. Now, a lot of that has eased. Where you're seeing it a little bit now, particularly, is in defense spending. We've sent so much armaments to Ukraine that they have to be replaced. And so we're seeing defense spending rising, which is something that's going to add to GDP. Brings up a debate on Capitol Hill, of course, about spending levels. But Congress has always hid defense spending in these continuing resolutions and off budget. So I imagine it's not going to. I imagine it'll be the same this time.
The Prime Minister of Ukraine is the most interesting guy with many different public duties over the years, but all working around trade and the economy of a pre-war and at present war. in Ukraine. In London, our Maria Tadeo in conversation with Dennis Shmihal.
Tom, good morning. And we are joined by Ukraine's Prime Minister, Mr. Michal. Thank you so much for being with us. We've seen each other in many conferences like this multiple times. And I know how difficult it is for you to get here. It's this train from Ukraine, very big country, over to Poland, and then a lot of security concerns about your staff, your team, yourself. So we appreciate your time. And one of the things that you always tell me is when I come to a recovery conference like this, and there's been many, I do feel our allies say we stand with Ukraine, and they mean it. But a war is long, it's expensive. Did you feel any fatigue in this runaround?
Thank you so much for invitation. It's a pleasure to be here with you and morning. So it's second conference for Ukrainian recovery. First one was held in Switzerland 1 year ago. Today we are in London. 62 countries and international organizations are here. Hundreds of businesses are here, international businesses. We feel tremendous support from all of our partners. We feel financial support, sanctional, military support, humanitarian support. Results of this conference have a long-term consequences. We have many promises. We have many concrete agreements, declarations, memorandums. We have financial support. We have middle-term program for Ukrainian support from European Commission, from European Union for 50 billion euro for the next 4 years. We have tremendous support from United Kingdom. We have very good meetings with our partners and with United States Secretary of State. We have very good conversations, negotiations, and very good results.
And yet, while all of this is happening, we know that back home, the fighting continues and the counteroffensive is going. And I do want to make something very clear. Was there at any point in this conference, did you get any hint that anyone suggested the funding will depend on the counteroffensive?
Absolutely no.
If it's successful, more money. If it's not, it would be less. No one told you that.
We have very, very sustainable, very strong and very unwavering support from our partners. There is no dependence from results on the battlefield.
They are entirely different.
Absolutely. We have very strong messages, especially on that conference. Ukraine is future member of EU. Ukraine will be supported by partners. Russia must pay because of these consequences of this war, of terrible war and aggression from Russia's side. So these messages from partners are very supportive, are very promising, and now we continue our counteroffensive. This is not easy walk. This is not Hollywood movie, as our President Volodymyr Zelensky said yesterday.
Yesterday, he seemed a little bit exasperated. This is not a movie. It takes time. It takes patience. Absolutely. Is that what you feel at times too? This is not Hollywood. It's real people and it's lives.
Yes, and every life is very important for us. And we are not Russia. We are not Soviet-style army when they bring their lives to the fire of the war. So we are very careful. We are very smart. We use NATO standards in this war because we are fighting according to NATO standards. We are fighting for weaponry of NATO countries. And counteroffensive, it's multiple operation. It's offensive, it's defensive operations, it's tactical pauses. So it will take time, but we have first results.
It's too early to make an assessment.
Absolutely.
Now, that's what you say.
We have first results of our counteroffensive. 8 villages are liberated. More than 113 square kilometers is liberated. 7 kilometers go into the head from the front line. So it's very important results for the 2 weeks, and we will continue.
And sir, of course, now you have, you're on Bloomberg TV, of course, you have the investment community that's watching this interview, but you also have a lot of taxpayers, some of whom are very sympathetic to Ukraine too, but they say we want to see value for money, but also this idea of corruption at times. I remember President Zelensky said, my government will crush the oligarchs. We will be a before and after moment in Ukraine. Is that the moment or the message that you're sending to people? Things are changing in Ukraine.
Ukraine is changing, absolutely. President, our government, we have zero tolerance to the corruption.
You will ditch people that are corrupted if you find anyone.
We finished formation and creation of our anti-corruptional infrastructure together with our partners. We are absolutely transparent, accountable, and open. And this anti-corruptional infrastructure is working now, and we demonstrate to all the world that we are fighting with a corruption country. And we will have results. We continue our reforms, we continue digitalization, we take off state and public services from persons and go to the digital space, and this is very, very effective way to fight corruption. Just don't let people to be corrupted, because digitalization brings new technologies and new possibilities.
And can I ask you, your meeting with Mr. Blinken, the U.S. Secretary of State, he was here, and I know you had a one-to-one meeting. There's an election coming up in the United States. Is that something that worries you, or did he tell you the United States is in for the long haul? This is about values for the U.S.
United States is very important partner, is the biggest supporter for Ukraine. So we discussed all the important issues. We discussed, first of all, financial support, and Mr. Blinken announced the next $1.3 billion support, financial support for Ukraine, for our reforms, for our recovery, for our energy sector. It's very important for us. We also discussed all other issues, very important in sense of development of my country despite the war. Demining activity, sanctions against Russia, development of energy sector in Ukraine, and many other very important issues. So
the meeting went well, and I also wonder, however, with the average American that may be watching this too and is thinking, but Ukraine is a far way off. I don't know anything about this country. What's going on there with my money? What's your message? What would you say? Stay with us because what?
First of all, we are very grateful to American people, to United Kingdom people, to all our partners who support us military, financially, by sanctions. It's crucially important because we are fighting not only for our land, for our families, for our people. We are fighting for democratic and for civilized values. It's crucial. And because of this, all democratic world support Ukraine. Why? Because this is about global security system. And it's very important, don't let any aggressor to have a free thinking about future possible aggression.
If Russia were to win this, and it's a hypothetical, then would you say it would be the moral collapse of the West? If we let that happen, it would be the moral collapse of the West.
I think that...
You don't even contemplate Russia winning.
It's impossible. It's impossible, and I think that I'm sure that civilized world will not let Russia win this war, because it's about existential things. It's about the world security system. And from my side, I should say that Ukrainians have no intention, no imagination that we may lose this war, because it's about our existence. It's war with war crimes, with war against humanity, with genocide against Ukrainian nation. So if Russia will win this war, it will mean that Ukraine and Ukrainian nation is not exist anymore. So from our side, we understand that we will liberate our country in the borders as on the 1991.
And it is existential. That's a word I heard the most the last time I was in Ukraine, that this was existential for the country now. And I want to ask you, however, another existential question perhaps is the NATO summit. You said in this conference, for a strong economy, you need a strong country, and that means security. What's going to happen in that meeting? President Zelensky said, my people have shed blood for a timeline now to NATO. What's going to happen in a month's time in that meeting?
I may repeat, we are fighting according NATO standards. We are fighting by weaponry of NATO.
So why is it so scary for some?
In fact, our army is NATO army right now. We are fighting for the same principles for which NATO was created. So I'm sure that membership of Ukraine in NATO, it will be a very win-win situation, very mutually beneficial situation. So we are waiting that this summit in Vilnius will be a very strong summit, and we will hear very concrete and very strong messages about Ukrainian membership in NATO. And we hope that partners will do this. We have 20 allies which are supporting Ukraine, which signed some declarations. We discuss with some skeptical allies, but we have sure inside of our hearts that everything will be good.
And very briefly, sometimes you hear people say, just sit down and talk to Vladimir Putin. When you hear the name Vladimir Putin, does it trigger anything in you, or you just go, this is in the past, I'm not interested in Vladimir Putin?
Putin is the biggest crimer of our times, of 21st century. We don't believe that he may do something to bring peace in Ukraine. So only his step to stop shot and take off Russian army from Ukrainian territory may stop this war and bring peace back on the European continent. But he has this possibility since 214. So we understand that this is now impossible.
And for you, you say it's now impossible. It's too late. Prime Minister, thank you so much. Appreciate it. Always very good to see you in Bloomberg. And thank you for being here with us in London. Thanks.
Thank you so much.
Tom?
Maria Tadeo, thank you so much for a piercing conversation ending with comments of Ukraine on the leader of Russia. Futures at -11, Dow futures at -85. This has been an extraordinary day. I have to say to the team, I think we blew up the show 3 times to bring you experts on these issues. Stay with us. This is Bloomberg. Good morning.